Moving on to the next concept, that is a fantastic, interesting concept that is called as tea, coffee, rubber, development account. Say, listen friends, this is section 33AB. Listen, if you are a grower and a manufacturer of tea in India, say you are in the business of growing as well as manufacturing what? Tea in India. What do you mean by growing and manufacturing tea? Say you have a tea plantation. From the tea plantation, you are plucking tea leaves, you are processing the tea leaves, and you are selling tea dust. Are you with me? You are making tea out of tea dust only. So you have a plantation, you are planting tea leaves over there, you are plucking the tea leaves, processing it, and you are selling tea dust. So we can say that you are in the business of growing and manufacturing tea, or similarly coffee or rubber in India. If you are in the business of growing and manufacturing either tea or coffee or rubber in India, then you can claim a special deduction in accordance with section 33AB. That's what the department says. You can claim what? A special deduction in accordance with section 33AB. Let's see what exactly is that deduction. For claiming deduction, assessee should deposit an amount with NABARD or in an account to be known as deposit account before the expiry of 6 months from the end of the previous year or before due date of furnishing return of income, whichever is earlier. Simply you will not get deduction. For getting deduction, there are certain criteria. So for claiming deduction, the first condition what they are saying is you should deposit some amount where either with NABARD or in an account to be known as deposit account. Either in deposit account or with NABARD, you should have to maintain a deposit. Are you with me? And you should deposit money when? Before the expiry of 6 months from the end of the previous year or before due date of furnishing your return, whichever is earlier. Simply it means what? Say for example, friends, listen, you are a tea grower as well as manufacturer in India. You want to claim a deduction under 33AB in the year 2024-25. You are planning to claim a deduction under section 33AB in the year 2024-25. If you want a deduction, you deposit some amount where, say with NABARD, you have to deposit an amount with NABARD when either within 6 months from the end of relevant previous year. End of relevant previous year means 31st March 2025. 6 months from the end of the previous year means 30th September 2025. That means April, May, June, July, August, September. Either on or before 30th September 2025 or on or before due date of furnishing your return of income, whichever is earlier. Say this is a company, then due date of furnishing return of income will be 31st October 2025. So technically you have to deposit the amount on 30th September 2025. What they are saying is you must deposit an amount with NABARD or in a deposit account either before 6 months from the end of relevant previous year or before due date of filing your return of account, return of income, whichever is earlier. Are you all here? In most of the cases, it will be 30th September 2025 or 30th September of that respective assessment year itself. So that's what the department says. So coming back to the point, so you have to deposit something either before expiry of 6 months from the end of the relevant previous year or before due date of filing your return, whichever comes first. You can deposit in the relevant PY itself, no problem. Maximum date is from the end 6 months. That doesn't mean that you have to wait until the end of the PY. Okay. Now, if you deposit some amount with NABARD or deposit account, then how much is the deduction? That is question number 3. What is deduction? Amount of deduction shall be a sum equal to the aggregate of the deposits made or 40% of the profits of the business, whichever is lower. Your deduction shall be lower of these two. Either deposited amount or 40% of your profits, whichever is lower. Either you take 40% of the profits or you take the deposited amount, whichever is lower. Now there will be one question. 40% of what? Profits. What is this profit? There is a note. Profit before making any deduction under this section and adjusting brought forward business loss under 72. Profit here means your Pgbp profit before adjusting deduction under 33AB as well as before adjusting brought forward business loss from past year. Before adjusting these two, whatever profits that you have under Pgbp, you take that profits 40%. That is limit number 1. Or you take the deposited amount as limit number 2. Then you compare and pick the lower. Are you with me? Why they are saying before claiming deduction under 33AB? Because we don't know how much is the deduction under 33AB. We are about to compute that. For that only they are telling you to compute the profits. So before 33AB as well as before adjusting the brought forward business loss, whatever the Pgbp profit you have, you take 40% of that particular profit or deposited amount, whichever is lower shall be your deduction. Are you all here? Yes, so 3 things. First of all, you have to be either tea or rubber or coffee growing and manufacturing in India. Then you have to deposit an amount with either NABARD or deposit account. When should you deposit? Either before due date of filing your return or before expiry of 6 months from the end of your relevant previous year. If you do this, what's your advantage? You can claim the deposited amount or 40% of your profits, whichever is lower, as a deduction. Is this much clear? Now there are certain conditions. Once you take this deduction, there are certain conditions that you have to satisfy. That is what is given as notes in the right hand side. So listen. Notes. The assessee would withdraw the amount in deposit account for any purpose which is specified in the scheme. Okay, you have a deposit with NABARD. Yes or no? Can you withdraw the deposit? Yes, but only for notified purposes. You cannot simply withdraw the money from the deposit account according to your wish. Not permissible. The assessee should withdraw the amount in deposit account for any purpose which is specified in the scheme. What is the scheme? Listen. See, tea, coffee and rubber are 3 important crops in India actually. Because everybody loves tea and coffee. If enough adequate tea leaves and coffee beans are not here, then government of India have to import it. So somehow they have to promote this tea, coffee as well as rubber. So the major problem with these 3 crops is all of these 3 crops have a yield period. That means we'll think about tea. Tea bushes have a yield period. After the yield, what will happen? You have to replant the tea. You have to replant the bush. Replantation also will take, I don't know what exactly is the time frame for the next tea plucking, but at least it will take 2 to 3 years. That's what my understanding is. And for rubber also 4 to 5 years replantation period is required. So that person who's into the business will kind of suffer in this period. They will end up in huge loss. So what those persons used to do is they ask for subsidies from the government. And the government used to give them subsidies also. Why? Because the government want them to run the business, run the activity. Otherwise, there will be a short of tea, coffee, etc. in India. So the government used to give them subsidies. So the government thought of introducing a deduction under 33AB. If you have profit this year, you take 40% of that profits and deposit in deposit account. Once you require money in future for tree replanting or the other things, you can withdraw the money and you can utilize it. Your corresponding tea board or coffee board or the rubber board will decide which all are the things, which all are the notified items or what all are the expenses that you can incur as per the scheme. So Income Tax Act is silent. We don't know, or they are not saying that what all are the eligible purposes. They are only saying you follow the scheme which is set up by the corresponding board. If it is tea, tea board, coffee, coffee board, rubber, rubber board. Whatever the scheme set up by the corresponding board, you follow that scheme. You withdraw the amount only for those expenses which are notified in the scheme, not for other purposes. Are you with me? So the government want these 3 businesses to be self-sufficient. That's what they are saying. If you have profits, take 40%, deposit, then you take the deduction. You be happy, we'll give you deduction. And in future, you withdraw the money and utilize it for your own purposes. Don't come and ask for us subsidy. Are you all here? So coming back to the point, friends. The first point is assessee should withdraw the amount in deposit account for any purpose which is specified in the scheme only. Now, if the deposit amount is withdrawn for the following purchases, then it shall be deemed to be a taxable income of the assessee. So there are certain don't do list. What do you mean by don't do list? You are not supposed to withdraw money for the following purposes. Not supposed to withdraw money for the following purposes. If you withdraw money for the following purposes, what will happen? That money withdrawn is a kind of a violation. Then that have to be your deemed business profits. Let's understand. First purpose. Any machinery, plant installed in any office premises, residential accommodation including a guest house. You are not supposed to withdraw money to buy a machinery which is to be installed in your office, residential accommodation or guest house. Not permissible. Withdrawing money to buy an AC in office. Is it possible? No. Withdrawing money to buy a computer in office. Is it possible? No. Withdrawing money to buy a computer in factory. Is that possible? Yes. Because there are certain automated computers which is used by this for the grinding process and all, to measure the temperature, to measure the dryness, etc. There are certain automated machines. For that, you can actually buy a computer and install it in your factory, no problem. But in office premise, residential accommodation, guest house, not permissible. Then, you are not supposed to buy any office appliance at all. You are not supposed to buy any office appliances at all. Then any machinery or plant where whole of the part of the cost is allowed as deduction. You are not supposed to buy an asset where whole or a part of a cost is already allowed as deduction. Or rather we can say, you can buy an asset but don't claim any depreciation or other deduction. That is a better way to say that. Only after purchasing you are about to claim depreciation. So when you purchase, you are not supposed to claim any other deduction like depreciation or any other scientific research or something like that. You are not supposed to claim. And finally, any machinery specified in the list of 11th schedule. There are certain assets mentioned in the 11th schedule. For those assets are also ineligible assets. Those assets are, you are also not supposed to purchase those assets as well. So 4 negative lists is there. You are not supposed to withdraw money for purchasing these assets. You tell me, what if you withdraw money for purchasing these assets, what will happen? That money withdrawn shall be treated as a violation, and that will become your deemed business profits. Listen. Now, what is next one? Where amount withdrawn from the deposit account for being utilized by the assessee for the purpose of such business and is not utilized in accordance with the scheme or deposit scheme in that year. In what? In that year. Then the unutilized amount shall be deemed to be the profits and gains chargeable to tax as income of that previous year. 2 things are there. When you withdraw an amount, 2 things you have to be careful. Number 1, you have to utilize that amount only for notified purposes or eligible purposes. Number 2, in the year of withdrawal itself, you have to utilize it. In the year of withdrawal itself, you have to utilize it. Otherwise, you will roll your money. You roll the amount. Whenever you withdraw, that year itself, you have to utilize it. You are withdrawing this year. Say you are withdrawing on 15th March 24 and utilizing it on 4th April 24. Then what will happen? It is considered as a violation only. In the year of withdrawal itself, you have to utilize it. If you are not utilizing it in the year of withdrawal itself, then even if it is utilized for eligible purposes next year, that will not be considered as a legal utilization. That will be considered as misutilization only. That's what the department says. So 2 things are there. Withdrawn amount, number 1, have to be utilized in the year of withdrawal itself, that too for eligible purposes. Both are important. If you violate any, then the amount shall be treated as your deemed business profits. Moving on. There is another trick. Say you can buy a plant and machinery to be installed in the factory. That is possible. You can withdraw the money to purchase a plant and machinery to be installed in your factory. Possible. I purchased a plant and machinery and have installed it in the factory. Then for the next 8 years, I am not supposed to sell that plant and machinery. Then for the next 8 years, I am not supposed to sell that particular plant and machinery. Are you with me? So the point is very simple. Once you purchase an eligible plant and machinery in accordance with the scheme, you are not supposed to sell that particular plant and machinery for the upcoming 8 years. There is a lock-in period for the plant and machinery. What is lock-in period? If you sell it, say, you withdraw the money, you purchase a plant and machinery, next day you are selling it and you are rolling the money back. Not possible. Then in future, you will come back to us by asking for subsidies. So you do one thing, you are buying some eligible plant and machinery, use it for the next 8 years. If you sell it before 8 years, that also will be considered as what? Violation. So that's what the department say. Lock-in period for any asset which is purchased in accordance with the scheme is how many years? 8 years. Then what is next? Where an asset as above is transferred during the lock-in period, then portion of the cost relatable to the deduction allowed under 33AB subsection 1 shall be deemed to be income taxable under Pgbp. If you are violating that lock-in period condition, then the proportionate deduction that you have claimed at the time of deposit, that portion shall be deemed to be your business profits. You are depositing something and you have claimed deduction. Then you are withdrawn it based on a condition that you will buy an eligible plant and machinery and use it for another 8 years. You withdrawn the money, bought a plant and machinery and you sold it before 8 years. Then that withdrawn money's proportion that you have already claimed as a deduction have to be reversed because you have violated the promise. So that amount have to be reversed and it have to be treated as your deemed business profits. I hope you got it. It's logical only because we told you to deposit the amount and take the deduction based on a promise. What is that promise? Or based on a condition? What is that condition? I will withdraw it only for buying eligible plant and machinery. That too, I will not sell that eligible plant and machinery for another 8 years. You violated it. So the withdrawn money where you claimed it as a deduction shall be your deemed business profits. Now, hope you have studied composite income in your inter-syllabus. Tea growing and manufacturing profit is considered as composite profit. So, let's understand what is the combination of this composite profit along with the 33AB deduction. Listen, if you are in the business of tea growing and manufacturing, according to income tax rule number 8, 60% of your profit shall be deemed to be agricultural income. Only 40% of your profit shall be deemed to be business income. Along with that, you will get 33AB deduction. Similarly, if you are growing and curing coffee, rule 7B, 75% shall be deemed to be your agricultural income. Only 25% shall be deemed to be your business income. Along with that, you will get 33AB. If you are in the business of coffee growing, curing, roasting and grounded, that means the filter coffee. Okay. So, according to rule 7B, 60% of your profit shall be agricultural income and only 40% of your profit shall be deemed to be business income. Along with that, you will get 33AB. And finally, if you are in the business of growing and manufacturing rubber, according to rule 7A, 65% of agricultural income and 35% shall become your business income. Along with that, you will get 33AB. Now it's little bit confusing. You are getting that and this. How we will accommodate everything in exam? For that, there is a thing called steps for calculation. How do we accommodate everything if there is a question in relation to this in examination? This is not a section. This is only to make you understand how to accommodate everything. First of all, what you need to do is compute your taxable income under Pgbp. Just like a normal business, you do everything. Then claim 33AB deduction. First, you compute the entire activity as similar to a normal business activity and you compute your normal Pgbp profit. Then you charge 33AB deduction. Whatever the profit remaining shall be treated as the composite profit. Okay, after claiming 33AB deduction, whatever amount remaining have to be splitted. 60% agriculture, 40% business. Are you with me? Then you apply that rule number 7A, 7B and rule number 8. Depends upon the type of business that you are doing. After that, you will get some business profits. From that business profit only you set off losses from the last years. After setting off that loss, you will get the final taxable income under Pgbp. So this is the order that you have to follow. First you compute everything except 33AB. Then you charge 33AB. Then the amount from where you charge 33AB, that net amount, on that you apply 60-40 rule or 75-25 rule or 65-35 rule, whatever it is. Then on the remaining business profit, you adjust the past year's brought forward business loss. Then the remaining amount, whatever it is said to be the taxable PGBP profits. Are you all here? Now, deduction under 33AB shall not be allowed unless accounts of the business have been audited by a chartered accountant before the due date under 44AB. You have to mandatorily carry out an audit for claiming this 33AB deduction. And any amount utilized in accordance with the scheme again is not allowed as a deduction in computing the business income. Say for example, you have deposited an amount, claimed it as a deduction, you have withdrawn the amount and you spend it for the eligible purpose. Now can you claim that expenditure again as a deduction? No. Why? Because already at the time of deposit we have given you a deduction. You are withdrawn money and utilizing it as per the scheme. Then don't come and say that we have spent some money as per the scheme, give us deduction. No, because at the time of deposit itself, we have given you deduction. For the utilization again, don't ask for deduction. Are you with me? At the time of deposit itself, we have given you deduction, right? Now, when you are spending it, don't come and say that we have spent money for the business. We want more deduction. No, because one expenditure, one deduction, not twice. And finally, there are two more notes. What is that? On closure of business or a dissolution of a firm, amount withdrawn shall be deemed to be the profits and gains of business of that previous year. Say for example, you were running a firm. That firm has growing as well as manufacturing tea, coffee, rubber. At the time of dissolution, you thought of withdrawing that entire money. You are planning to withdraw the entire money at the time of dissolution because the business is getting dissolved. You don't have to maintain that deposit again. When you withdraw it, that entire withdrawn amount shall be deemed to be your business profits. But however, in the case of a liquidation of a company or a death of an associate or in the case of partition of HUF, if you are withdrawing money, it shall not be taxable. If it is a company and the company is getting liquidated, no problem. If it is on account of death of a person, you are withdrawing money, no problem. If it is on account of partition of HUF, you can withdraw, no problem. There won't be any taxable effect. But normal closure or dissolution of a firm, you are withdrawing money, that entire withdrawn money shall be deemed to be your profits taxable under PGBP. Is that point clear? So friends, technically the next section that we have to study is section 35, that is expenditure on scientific research. So section 35 is another deduction under PGBP where you can divide that particular section into two. Okay, the first part is deduction for in-house scientific research expenditure. The first part is what? Deduction for in-house scientific research expenditure. What do you mean by in-house scientific research expenditure? Very simple. Say you have your own R&D. R&D means research and development department. And you are incurring certain expenditure in your own R&D. That expenditures are allowed as a deduction under section 35 according to the first part of section 35, that is in-house scientific research expenditure. And section 35 also have one more part, that is deduction for outside contribution. We can call it as part number 2. That means you are donating something to certain approved institutions. You are donating some amount to certain approved institutions which does scientific research. For that, department have to appreciate you. Why? Because you are promoting indirectly the scientific research in India. So if you are donating something to an approved institution which is provided under section 35, that donation is also eligible as a deduction under section 35 according to the conditions and other things. So we can divide section 32 basically into two. 35 basically into two. First part is in-house scientific research expenditure and the second part is deduction for outside contribution. So let's understand each one by one. So friends, let's start with the part number 1, that is in-house scientific research expenditures. So listen friends, very simple. Say for example, we can divide this in-house scientific research expenditures into two. Number 1, revenue nature expenditure, and number 2, capital nature expenditure. What do you mean by revenue nature in-house scientific research expenditure? Example, salary paid to scientists, purchase of raw material, then printing and stationery, rent in relation to building, then postage and telegram, power and fuel. These are the examples for revenue nature in-house scientific research expenditures. Are you all here? Second one is capital nature in-house scientific research expenditure. Example, purchase of apparatus, purchase of plant and machinery, purchase of building, etc. are the examples for capital nature scientific research expenditures. Now, this revenue nature scientific research expenditures again can be divided into two. Number one, pre-commencement and post-commencement expenditures. What do you mean by pre-commencement? Before starting your business, certain companies soon after the incorporation, they will start doing the research. Because whenever they start selling some product, that product should have certain core competencies compared to their competitors. Say for example, I'm a mobile phone company. If I simply introduce a mobile phone to you, nobody will buy that because there are n number of mobile phone companies in the market. Are you with me? Say I'm introducing a mobile phone with an ultra tech. Say for example, there is an inbuilt drone in the mobile phone. So maybe people will buy it because no other mobile phones have that much tech involved. So to put an inbuilt drone, I have to do a thorough research. Yes or no? So certain companies, even before they start their business, they will start R&D. If you are doing an R&D just before starting the business and you are incurring certain revenue nature expenditure in relation to that phase or during that phase, it is called as what? Pre-commencement revenue nature expenditures. Now, the question is, in the pre-commencement phase, since we don't have a business, we don't have a head called Pgbp. The Pgbp head will come into the picture only when you start your business. So what department say is, whatever expenditure, whatever revenue nature expenditure that you claim, that you incur in the pre-commencement era, you cannot technically deduct it from Pgbp. So you do one thing, you accumulate it and claim it as a deduction when you start your business. Now the question is, can you accumulate all type of pre-commencement revenue nature expenditure? No. What department say? Payment of salary to research personnel and purchase of material that too incurred within 3 years immediately preceding the commencement of business is allowed as a deduction in the year of commencement. So two types of revenue nature expenditure which are incurred during the pre-commencement phase, that too incurred within 3 years immediately preceding the date of commencement. Say today you are commencing your business, whatever these two expenditure that you incurred during which period? 3 years just before today's date, you can accumulate and claim it as a deduction in the year of commencement. That's what the department say. So question number one, can you claim all revenue nature scientific research expenditure as a deduction in the year of commencement? No. Only two types of revenue nature pre-commencement expenditure is allowed as deduction. Which are the two types? Number one, salary to research personnel. Number two, purchase of raw materials. These two are the only pre-commencement revenue nature expenditures that you are allowed to claim as a deduction. Second one, can you claim whatever these two expenditure that is incurred more than 3 years? No. If these two expenditures are incurred within immediately preceding 3 years to the date of commencement, then you can claim it as a deduction in the year of commencement. So that is what they are saying. Payment of salary to research personnel and purchase of material incurred within 3 years immediately preceding the commencement of business is allowed as a deduction in the year of commencement. So that is the pre-commencement revenue nature expenditure. How about the post-commencement? Pretty simple. Any revenue expenditure incurred on scientific research would be allowed as deduction in the year in which it was incurred. Very simple. In the post-commencement phase, whatever revenue nature expenditure that you incur, you can claim it as a reduction in that year itself. There is no point of any confusion. All the rent, all the purchase, all the telegram, whatever expenses that you are incurring during the post-commencement phase is allowed as a reduction in that respective year itself. There is absolutely no problem. Now, next, how about capital nature expenditures? What is the normal treatment of capital nature expenditures according to the income tax law? You capitalize, then you charge depreciation. This is what is the normal treatment of capital nature expenditure according to the income tax law. Yes or no? But section 35, what they are saying is, pre-commencement capital nature expenditures, the aggregate of the expenditure so incurred within 3 years immediately preceding the commencement of business is allowed as a deduction in the year of commencement. So one great advantage you have, you are incurring any capital nature scientific research expenditure in the pre-commencement phase. You accumulate all the capital nature expenditure that you incur within 3 years immediately preceding the date of commencement. You accumulate it. Then you claim it as a deduction straight away from the year of commencement onwards. You don't have to capitalize it and you don't have to charge any depreciation. Rather, you directly deduct or you directly claim the entire cost of the capital expenditure as a deduction from your taxable profit in the year of commencement. So it's a great offer given to the assessee by the department. Now, how about post commencement capital nature expenditure? Any expenditure of capital nature on scientific research related to the business carried on by the assessee would be deductible in full in that respective year itself. So whatever capital expenditure that you incur in the post commencement phase is allowed as a reduction in that respective year itself. You don't have to capitalize it and you don't have to charge any depreciation. Rather, you can directly claim those post commencement scientific research expenditure which are in the nature of capital as straight away as a deduction from your taxable profits under section 35. Now, there are certain additional things that you should know. When we say capital nature expenditure, it includes expenditure on land. Yes or no? But department say expenditure on land is disallowed. No deduction will be allowed in respect of capital expenditure incurred on acquisition of land, whether land is acquired as such or part of any property. If you are acquiring land or you are acquiring land and building, the proportionate cost of land is never allowed as a deduction. You cannot claim cost of land as a deduction under section 35 because what department says is land will be land. Whether you do scientific research or not, land will be always land, hence no deduction for any cost of land. Note number 2. Salary if paid before commencement of business shall specifically excludes perquisites. Listen, normally when we use the word salary, it means what? Whatever benefit given by the employer to the employee can be called a salary, like basic salary, allowances, perquisites, etc. Yes or no? In the pre-commencement phase, payment of salary to research personnel, when they say payment of salary to research personnel, that salary in the pre-commencement phase specifically excludes perquisite. That means if the employer is giving perquisites to the employee, that is not allowed as a deduction in the pre-commencement phase. That means if you are giving perquisites to your scientist before commencement of your business, the value of benefit that you given to your scientist is never allowed as a deduction under 35. How about post-commencement phase? No problem, you can claim. In the post-commencement era, you are giving some perquisites to your scientist or research personnel. Definitely you can claim that perquisite as a deduction. The restriction is applicable only for pre-commencement perquisites given by the employer to the research personnel. That is not allowed as a deduction. In the post-commencement phase, if you are giving any perquisites to your scientific related staff or something, definitely that is allowed as a reduction in that respective year itself. Are you all here? Moving on. Carry forward of deficiency. Let's understand what exactly is this carry forward of deficiency. Capital expenditure incurred on scientific research which cannot be absorbed by the business profits of relevant previous year can be carried forward for indefinite period. So imagine when you charge all this capital expenditure as a deduction straight away from your profits, do you think that you will be having that much adequate profits in year 1 itself? No. If you have any unabsorbed capital nature scientific research expenditure, you can carry forward that unabsorbed capital nature scientific related expenditure to indefinite subsequent years until it is fully set off. You can carry forward it to how many years? Indefinite period you can carry forward. There is no restriction for the period in which you can carry forward. You can carry forward it to unlimited subsequent years. That's what the department says. Are you all here? There is no time limit or there is no expiry period for the carry forward. You can carry forward it to unlimited subsequent years unless otherwise it is fully set off. So, capital nature unabsorbed scientific research expenditure can be carried forward to unlimited subsequent years. How about revenue nature expenditure? It is treated as a normal business loss only. It is treated as normal business loss only. Capital nature scientific research expenditure can be carried forward, treated separately, and can be carried forward to unlimited subsequent years. That's what the department says. And one more note is there. Such asset is not eligible for depreciation under section 32 once you have claimed a 100% reduction for this asset, you are not eligible to claim depreciation from the same asset because we have already given you 100% deduction. Now no more depreciation. I hope it is clear. Section 35 2AB is again irrelevant for us, so you don't have to focus that. Sale of asset representing expenditure of capital nature on scientific research is again another irrelevant topic. So again, I'm not focusing on that. You can read it by yourself if you want to read. Again, I'm not saying that you should read. It is absolutely necessary for your examination. Not necessary, we can say. Moving on to the second part of it, what is that? Amount contributed or paid to outside agency, that is absolutely required. Say you are a associate and you are giving donations to certain approved institutions. That amount of donation that you have given to approved institution is allowed as a deduction under section 35. Let's understand which are the donations that are allowable as deduction. Number 1, section 35 subsection 1 clause number 2. Sum contributed to a notified approved research association, college, university or other institution carrying scientific research. Deduction at 100% of such contribution. That simply means you are donating something to a research association or a college, university or other institution which does what? Which does scientific research. You are donating any amount to an approved research association or university or college institution, and the amount of donation that you have given to those institutions, if they are carrying on scientific research, is fully allowed as deduction. You donated something, that amount donated is allowed as deduction under section 35. Are you all with me? Now point number 2, section 35 subsection 1 clause number 2A. Sum contributed to approved Indian company for scientific research. You are donating something to a approved Indian company which does scientific research. Again, 100% of the donated amount is allowed as a deduction. You are giving a donation to any approved institution which does scientific research. Whatever amount that you have donated is allowed as a deduction under section 35. Then next one, section 35 subsection 1 clause number 3. What is that? Sum contributed to approved notified research association, college, university or other institution carrying on research in social science or statistical research. You are donating something to whom? Any research association or a college, university or other institution which does what? Social science and statistical researches. You are donating to these three institutions that does social science or statistical researches. Then the amount that you have donated is again allowed as deduction. And how much is the deduction? 100% of the donated amount is allowed as a deduction. And finally, section 35 2AA, what are they saying? Any sum paid to national laboratory or university or Indian Institute of Technology or specified person for carrying out approved programs or scientific research. Deduction at 100% of such contribution. That simply means you are donating any amount to any national laboratory or a university or the Indian Institute of Technology IIT or to any specified persons for conducting an approved program. Approved program means central government approved program. You are donating something. That amount donated is again allowed as a deduction under section 35. So 4 types of institutions. Number 1, research association, college, university or other institution that does scientific research. Number 2, Indian company that does scientific research. Number 3, research association, college, university or other institution that does social science or statistical research. And finally, national laboratory, Indian Institute of Technology, university or other specified person for approved programs. You are donating any amount, that amount donated is allowed as a reduction under section 35 as an outside contribution. Now there is one important note over there. See, at the point of donation, they had an approval. Subsequently, their approval got withdrawn. Say today I've donated. Today they had approval. After 1 month, their approval got withdrawn. So my question is, in this year end, am I eligible to claim deduction for the donated amount? Answer is yes. The only one thing that you have to always check is at the time of donation, whether they have approval or not. If at the time of donation, if they have approval, you can claim it as a deduction. Donated amount is definitely allowed as a deduction. And thereafter, their approval got withdrawn or not is not our concern. The only one thing that you have to check is at the time of donation, whether they have approval. If yes, you can claim that entire donated amount as a deduction under section 35. I hope it is clear. So we divided that into two, in-house as well as outside contributions. Moving on to the next topic, simple topic. Okay, simple topic it is section 35 ABA and section 35 ABB, that is amortization of spectrum and telecommunication license fee. Because deduction for these two are almost similar, subject to very few minute differences. So we are about to discuss this together. So we are about to discuss two things. Number one, amortization of spectrum fees. Number two, amortization of telecom license. First of all, what do you mean by spectrum fee? Say for example, this 2G, 3G, 4G, 5G, etc. are actually basically spectrums. They are natural frequencies. If you want to make use of this spectrum, say I am an internet service provider, Jio. I want to make use of this 5G spectrum. Then I have to take license from the Ministry of Telecom or Department of Telecom. Are you with me? To the Ministry of Telecom, I have to make a lump sum payment. Then I will get licenses. Imagine, say I have paid 10 lakh rupees to the Ministry of Telecom. I have paid how much? 10 lakh rupees to the Ministry of Telecom and I got license for 10 years. This is impossible. For 10 years, you will never get a license for 10 lakh rupees. But only for the sake of example, I am taking a smaller figure. Are you with me? Alright. So, for 10 years, I paid spectrum fee as how much? 10 lakh rupees. Or it can be a telecommunication license. Telecom license. What is telecom license? When you are taking your mobile phone and putting a number and click on the call option, the call is going, right? That is also another natural frequency. And if you want a telecom license, you have to pay a lump sum amount to the Ministry of Telecom or Department of Telecom. Basically, it is auction. It is on auction basis. So, coming back to the point, telecom license or spectrum fee, I paid 10 lakh for 10 years. Then, basically, what department say? Under section 35A, B, A for spectrum fees and under section 35A, B, B for telecom license. Assessee can claim a deduction. This telecom license cannot be called as a capital asset. Why? Because you are not owning anything. You are only getting a license. So what department say? That license fee, that lump sum amount that you paid to get the license, that you can amortize. How to amortize? You paid 10 lakh for 10 years. Yes or no? So you do one thing, every year you charge 1 lakh rupees as amortization. Every year you can pay, you can charge how much? 1 lakh rupees as an amortization. The treatment of spectrum fee and telecommunication license is exactly the same. Whatever amount that you have paid, you divide that amount with the number of year of license that you got. So every year equal amount you can amortize, so that during the end of license period, you will be able to completely amortize the entire license fee that you have actually paid. Are you with me? So this is what we are about to discuss right now, and let's get into the theory. Section 35A, that is amortization of spectrum fee for purchase of spectrum. Number one, deduction shall be claimed in equal annual installment over the license period. That is from the previous year in which spectrum fee is actually paid and the balance period of license. There is one thing. Say for example, I'm supposed to pay 10 lakh rupees. 10 lakh is payable for 10 years license, but I paid only say 2 lakh in year 1. I paid only how much? 2 lakh in year 1. Then can I claim 10 lakh divided by 10? No. If I paid only 2 lakh, then what I need to do is 2 lakh divided by 10. That means in year 1, maximum amount that I can amortize is 20,000. Year 2, again say 20,000. Say year 3, beginning, I paid the remaining 8 lakh. I paid remaining 8 lakh. So in year 3 also, I can claim 20 plus I paid another 8 lakh. Now how many years I have? Including year 3, I have 8 years. Year 3 beginning I have made the payment. Including year 3, I have 8 years. So 8 lakh by 8. How much is the value coming? 1 lakh. So from year 3 onwards, I can claim 20 plus 1 lakh and I can claim 1,20,000 as a amortization. Are you with me? Likewise, when it is year 10, you will be able to completely amortize that entire 10 lakh rupees. So this is how you have to amortize. It is always based on actual payment. Once you paid it, how many number of years remaining, the amount paid divided by the number of years remaining, that's how you have to amortize. It's the same in the case of telecommunication license as well as spectrum fee. Are you with me? Moving on. However, spectrum fee is actually paid before the commencement of business, then deduction shall be from the previous year in which such business commenced and the subsequent period of license. You've already taken a telecommunication license or a spectrum fee. After 1 year only, you started your business. Then from the moment when you start your business only, you will be able to amortize it. Because the moment when you start your business only, Pgbp head will come into the picture. So, you have taken a license for 10 years in year 1, but you started business in year 2. Then 10 lakh divided by 9 years. This is how you have to amortize. It is always amortization to start from the commencement of business, from the year in which you commence your business. Are you with me? Is that point clear? Same in the case of telecommunication license. So these points are repeating again. Deduction shall be claimed in equal installment over the license period, that is from the previous year in which license fee is actually paid and the balance period of license. However, license fee is actually paid before the commencement of business, then deduction shall be from the previous year in which the business commencement and the subsequent period of license. So the only difference is the section number. Spectrum fee is 35A(BA) and telecommunication license is basically section 35A(BB). Expenditure for obtaining license to operate telecommunication services. Now, there is another thing, this also we should cover. On transfer of spectrum or telecommunication license, what is the treatment? If you are transferring the spectrum fee or telecommunication license, what is the treatment according to the income tax law? Let's understand. Listen. Say, for example, 10 lakh rupees worth the telecommunication fees and I've paid it for 10 years. Year 1, I'll claim rupees 1 lakh as amortization. Year 2, I'll claim again another 1 lakh as amortization. Say in year 3, the balance value is how much? 8 lakh. And I've sold that telecommunication license or spectrum fee, say for 5 lakh. I've sold it for what? 5 lakh. If I'm selling it for 5 lakh, the balance value is 8 lakh, then I'll end up in a loss. Yes or no? Yes or no? Yes. Balance value is 8 and I've sold it for 5. I'll end up in a loss and that loss is allowed as a deduction under section 35A(BA) if it is spectrum or under section 35A(BB) if it is telecommunication license. You can completely amortize this 3 lakh when you are completely sold that particular license and you are incurring a loss. Just like the terminal depreciation. You can completely claim this loss as a deduction under the respective 35A(BA) or ABB, wherever it is. Situation 2. I've sold it for 9 lakhs. Then, what is the treatment? Balance value is only 8. I've sold it for 9. I'm getting a gain of rupees 1 lakh. This gain shall be taxable as business profits. Taxable business profits, similar to balancing charge. Don't call it balancing charge. The concept is similar to balancing charge. Are you with me? Don't write balancing charge in your textbook, okay? The concept, the way we compute the gain is similar to balancing charge. Now, last one. I've sold it for 15 lakhs. You tell me what to do. Balance value is only 8. I've sold it for 15. Total gain is 7. Then 2 lakhs to capital gains. 2 lakhs to capital gains and 5 lakhs to, sorry, not 5 lakhs, 5 lakhs to capital gains and 2 lakhs business profits. Are you all with me? When I am selling this particular asset for a value which is over and above its Over and above its actual cost of acquisition, that excess value that I'm getting at the time of sale shall be treated as my income under capital gain. Whatever recovery of amortization shall be treated as your business profits as well. Are you all here? So the point that we were discussing is the concept is actually similar to what? Balancing charge, terminal and depreciation. It has no connection with the actual balancing charge and terminal depreciation. Okay, the way you compute the figure is something similar to the balancing charge and terminal depreciation. Now there is one more possibility where the proceeds from transfer is less than the balance value after amortization. Difference is allowed as a deduction under this section in the year of sale. Where the proceeds of the transfer of whole or part of the spectrum exceeds balance value, then the surplus to the extent of already allowed under this section shall be taxable as business income. And there can be one more possibility. Imagine, say my entire license payment was say 10 lakh. My entire license payment was how much? 10 lakh. I claimed 1 lakh each in year 1 and year 2 and the remaining value is 8 lakh. Now there is another possibility, say I am selling a part of my license. A part of my license say for 3 lakhs. I am selling what? A part of my license for 3 lakhs. What do you mean by part of license? Say South Indian license I sold. I had the Pan Indian license. South Indian license I sold. Are you with me? If the part of license is getting sold, then what to do? The balance value is 8. The sale value is 3. On the remaining value, for the remaining period of 8 years, I can what? Claim amortization because I've sold it on year 3. Including year 3, how many years I have pending? 8 years. What is the value I have? 8 was the original minus 3 is the sales value. So the remaining is 5. So by 5 by 8 should be the future amortization from year 3 onwards. If I'm selling part and the value balance is there, then from the value balance I claim balance number of years as an amortization. That's what the department says. Is that point okay? So where a part of license is transferred for a sum less than the balance value, then the balance amount which is not yet allowed as deduction shall be allowed as deduction in the balance number of years in equal installments. That's what the department says. And not one is there. Transfer of license in the scheme of amalgamation. That means the provisions of section 35 ABA and ABB will apply to amalgamated company as they would have applied to the amalgamating company as if the amalgamation has not been transferred the spectrum. That simply means in the event of amalgamation, in between the license period, say there is an amalgamation, the license will automatically get transferred to the amalgamated company. No problem, the balance number of installments can be claimed by the amalgamated company. Same in the case of demerger also. If there is a demerger in between, then the resulting company can claim the balance number of installments. That's it. Are you all here? So that is not true. Transfer of license in the scheme of demerger, that is the provisions of section 35 ABA or ABB, will apply to resulting company as they have applied to the demerger company as if the demerger company has not transferred the spectrum. I hope it is clear for you. Where were we? We were discussing section 35 ABA and 35 ABB. ABA is amortization of spectrum fee. ABB is amortization of telecom license. I hope both the sections are super clear for you. Moving on to the next topic, that is section 35AD, that is investment linked tax incentives for specified businesses. That's what we are about to discuss right now. Fantastic section it is. Say, if you are a specified business, then you will get certain advantages according to the Income Tax Act, or you will get certain deductions according to section 35 AD. That's what we are about to discuss right now. Section 35 AD. So listen friends, if you are a specified business which is listed or mentioned under 35 AD, what is the advantage? You can claim 100% deduction for all of your capital expenditures. You don't have to capitalize your capital expenditure and you don't have to claim any depreciation. I'm not saying you don't have to capitalize. You have to capitalize, but don't claim any depreciation. You have to capitalize, but you don't have to charge any depreciation. You can straight away claim that entire capital expenditure as a deduction. Are you all with me? So first of all, our duty is to understand which all are the specified businesses. This list you have to study, because in exam they may mix up normal businesses and specified businesses. You should be able to identify which is normal and which is specified. So this is comparatively a lengthier section. So let's understand what is the 35 AD. Specified businesses are as follows. Number one, what is the first specified business? Setting up and operating cold chain facility is the first specified business. What do you mean by cold chain facility? Huge cold storages, not like our normal chota cold storage shops. Say for example, say you are a fish exporter. Until you get customs clearance, you have to preserve your fish somewhere near to your port. So there will be cold storages where your fish will get a refrigeration of minus 40 degree and all. So you have to pay cooling charges over there. So those storages can be treated as a specified business, or we can say refrigerated containers. Again, a specified business. Have you seen containers with AC vents? The cold storages. So basically, cold chain facility you are providing in the business of cold chain facility, then that particular business can be called as a specified business. Number two, setting up and warehousing facility for storing agricultural produce. You have a warehouse where you store agricultural produce. That is your business. And if your business is warehousing agricultural produce, then that business can be called as a specified business. Moving on to the third one. What's the third one? Operating a cross-country natural gas or crude or petroleum oil pipeline network for distribution. What do you mean by cross-country natural gas, crude or petroleum oil pipeline network distribution? Say from India to Bangladesh, there is a petroleum or crude or natural gas oil pipeline network distribution. We are not talking about prospecting of petroleum or natural gas. We are talking about pipeline network distribution. You have a cross-country either natural gas or a crude or a petroleum oil pipeline network distribution, then that network distribution is considered as a specified business. Number four, building and operating a hotel of 2-star or above category anywhere in India. Say you have a 3-star hotel in India. That's a specified business. 5-star hotel in India, specified business. So category should be either 2-star or above. Say it's a normal tea shop. Is it a specified business? No. Moving on to the next one. Item number 5. What is that? Building and operating a hospital anywhere in India with at least 100 beds for patients. So you are a hospital where you can accommodate minimum 100 patients. That is considered as a specified business, but that hospital have to be in India. Okay. Moving on. Item number 6. Developing and building a housing project under slum rehabilitation. So slum rehabilitation. Have you heard about Dharavi? In Dharavi it actually happened. The small dwellings, Kala movie is based on this slum rehabilitation. There's a Tamil movie called Kala, acted by superstar Rajinikanth. Okay, so in that movie, it's all about slum rehabilitation. That means small dwellings over slum, they will demolish and the local authority will construct small houses for this. And if you are in that construction business, then you can call yourself as a specified business. Are you all here? Moving on to point number 7. Production of fertilizer in India. If you are a fertilizer manufacturer, you are a specified business. Point number 8. Setting up and operating an inland container depot or a container freight station. What is inland container depot? The place where these containers are preserved, just like a container yard. And what is container freight station? That lorry, the trailer lorry, where you transport that particular containers, logistics business. So if you are an inland container depot or a container freight station, you are considered as a specified business. Are you all with me? Moving on with point number 9. What is that? Beekeeping, production of honey and bee wax. If you are in the business of beekeeping or production of honey or bee wax, you are a specified business. And point number 10. Setting up and operating a warehousing facility for storage of sugar. Say you are running a warehouse for the storage of sugar. We are not talking about sugar manufacturers. We are talking about sugar warehouses. Now, first of all, let me ask you one question. Is sugar a agricultural produce? No, sugar cane is the agricultural produce. Sugar is actually a processed product. Sugarcane warehousing is also a specified business. Why? Because warehousing of our agricultural produce is a specified business. As well as sugar warehousing is also specifically given as specified business. I hope it is clear. Then, what is the next one? Item number 11. Setting up and operating a semiconductor wafer fabrication manufacturing unit. So, if you are in the business of manufacturing semiconductors, then you will be considered as a specified business. Are you all with me? So, if you are a semiconductor manufacturer, again you will be considered as a specified business. And point number 12, what is that? Laying and operating a slurry pipeline for transportation of iron ore. If you are in the business of transportation of iron ore, you have slurry pipelines for transportation of what? Iron ore. That also is considered as a specified business. And point number 13, developing and building a housing project under affordable housing scheme. Have you heard about affordable housing? A house with a limited square feet, just like a studio apartment. If you are an affordable housing developer, you will be considered as a specified business. And finally, point number 14, you are an Indian company in the business of developing and operating and maintaining a new infrastructure facility. You are an Indian company which develops infrastructure like road, rail, bridge, dock, airport, railway station, etc. You are a developer of infrastructure facilities. You will be considered as a specified business. So these 14 businesses are the notified, specified businesses, and you tell me what is their advantage? They can claim 100% deduction for their capital expenditure in the year in which they incur that expenditure. They can claim 100% deduction for the capital expenditure in the year in which they incur that particular expenditure. Not yet over. That's what they are saying. 100% of the capital expenditure incurred during the previous year, wholly and exclusively for the specified business, would be allowed as a deduction from the business income. Expenditure incurred on acquisition of land, goodwill, and financial instrument would not be eligible for deduction. Capital expenditure specifically excludes expenditure that you incur in relation with either your land or your goodwill or financial instrument. Whatever other capital expenditure that you incur is definitely allowed as a deduction under section 35 AD. I hope it is clear for you. And moving on to the next point. What is the next point? While making payment, if amount paid to a single person in a single day exceeds 10,000 and mode of payment is otherwise done by way of an account pay check or account pay bank draft or ECS or through prescribed electronic modes, no deduction is allowed. While claiming deduction under 35 AD also, say you have purchased a plant and machinery for 10 lakh and you have made that entire payment in cash. Can you claim that cost of plant and machinery as a deduction under 35 AD? No. Why? Because whenever you are about to claim a deduction under 35 AD in relation to capital expenditure, while paying that capital expenditure, if single day payment exceeds 10,000, then you have to make the payment either by way of account pay check or account pay bank draft or ECS or through prescribed electronic mode. If you are making the payment in any other mode apart from these four, then what will happen? Entire payment is not allowable as a deduction under 35 AD. Are you with me? Are you all listening? So, when you are making a payment which is allowable as a deduction under 35 AD and the amount of payment in a day more than 10,000, then prescribed method only you are supposed to make the payment. If you are making payment in any other mode, that much portion that you have made the payment is not allowed as a deduction under 35 AD. Moving on. Prior commencement capital expenditure is allowed as a deduction in the year of commencement if the same has been capitalized in the books of accounts of the assessee. What is that? See, here it is not like section 35, scientific research expenditure. Here what they are saying is, if you have incurred some pre-commencement capital nature expenditure, don't worry, you can claim that pre-commencement capital nature expenditure as a deduction when you actually commence the business. Nothing to worry. The only one thing is you have to capitalize that amount in your books of accounts. Then you charge 100% deduction when you actually commence the business. That 3-year limit is not applicable over here. Are you with me? Under section 35, we have learned a 3-year time frame limit. Those expenditure which are incurred within 3 years immediately preceding the date of commencement is only allowed as reduction. That's what we have learned under 35. Here there is no such condition exist. Moving on. Once assessee has claimed the benefit of section 35AD for a particular year in respect of a specified business, he cannot claim benefit under chapter 6A under the heading C deductions or 10AA from the same business for the same or any other year and vice versa. What do you mean by this? Listen. Say for example, I have a business and I've claimed 35AD deduction. And I've claimed deduction under section 35AD. From the same business, I cannot claim chapter 6A C heading deduction. What is C heading deduction? Under chapter 6A, there are profit linked deductions, certain profit linked deductions. You might have studied 3 C heading deductions for your in your inter syllabus. 80 JJAA, 80 QQB, 80 RRB. JJAA is the deduction for creating new additional employment opportunities, 30% of the employee cost. 80 QQB is deduction for royalty income received, either rupees 3 lakh or actual royalty income or 15% of the value of the book sold. Deduction under 80 RRB is for the patent income received. Have you heard about this? Likewise, there are deductions under 80 IA, IAB, IAC. IAC is for startups. The first 10 years, any 3 year, you can claim a profit holiday. 80 IAC. So, from deductions from 80 IA is called as chapter 6A C heading deductions. If you are claiming 35AD deduction from a business, from the same business, you cannot again claim chapter 6A C heading deduction or vice versa. What is vice versa? You are claiming chapter 6A C heading deduction, then don't even think about 35AD. If claiming 35AD, then don't claim chapter 6A C heading deduction. Likewise, if you are claiming 35AD, you cannot claim 10AA deduction as well from that respective business. What is 10AA deduction? Deduction for units established in ZES. Deduction for units which are established in ZES, Special Economic Zone. In Chennai, we have a Special Economic Zone. In Kochi, we have a Special Economic Zone. Say, if you start a unit in ZES, then what is your advantage? What department say? You can claim 100% deduction for your export profit. For your what? Export profit in the first 5 years. Then you can claim 50% deduction from your export profit for the next second set of 5 years. Then you can claim 50% deduction for your export profit, or you can claim amount invested in special reserve, whichever is lower, as a deduction in the last set of or third set of 5 years. So for 15 years you can enjoy benefit if you start a unit in ZES. Are you all here? But wait, if you are claiming 35AD, don't come and ask us for 10AA deduction or vice versa. You are claiming 10AA deduction, don't take 35AD deduction. Are you with me? This restriction is for a business, not for an assessee. What does that mean? Imagine I'm a company JK Limited. I have 2 businesses. One, mobile phone manufacturing, which is in ZES. And my second business is, say, fertilizer manufacturing, which is in a normal area. From fertilizer manufacturing, I can claim 35AD. From mobile phone manufacturing, which is in ZES, I can claim 10AA. No problem. If the fertilizer manufacturing is in ZES, then from the fertilizer manufacturing, I cannot claim both 35AD as well as 10AA. So the restriction is for a business, not for a assessee. Are you with me? If I have different businesses, one is 35AD and one is 10AA, definitely I can claim 35AD, 35AD, 10AA, 10AA, no problem. The restriction is for one business, you are not supposed to claim both. Same in the case of chapter 6A, C heading. Two businesses, one is eligible for C heading, you take that. Other is eligible for 35 AD, you take that. For a business, there is a restriction, you cannot claim both. Moving on to the next point, friends. What is the next point? Any asset in respect of which a deduction is claimed and allowed as a deduction under 35 AD shall be used only for the specified business for a period of 8 years. Fantastic. You are purchasing an asset for your specified business and you are claiming a deduction under 35 AD. You have some other business also. Can you transfer your asset which is purchased for specified business to your other businesses? No. There is no interdepartmental transfer. If you have a specified business and you purchase an asset for the benefit of specified business and you have claimed a deduction, then for the next 8 years, that specified business only have to use that particular asset. You are not supposed to transfer it even internally. Not possible. There is a lock-in period. Otherwise, what will happen? If I have multiple businesses, I will purchase all the assets in the name of specified business. Then I will claim 100% deduction. Then I will transfer that asset in the name of my other businesses. That should not happen. If you are purchasing an asset in the name of specified business, for the next 8 years, that asset have to be used only for the purpose of specified businesses. Are you all here? Is that point clear? Great. Now, what if I am transferring that particular asset to my normal business? I'll explain it by way of an illustration, okay? Listen. Say, year 1, I had a building which I purchased for 10 lakh. Okay, and I claimed 100% deduction. Year 2, I transferred this building to my normal business. I had a normal business as well. I transferred this building to my normal business. So it is not an outside sale. JK Private Limited has two businesses, one specified and one normal. I purchased an asset in the name of specified, then I transferred it to my normal business. Is that a problem? Yes. I'm not supposed to transfer that particular business to my normal business for another 8 years. If I transfer it, then what department say? You have claimed a deduction based on a promise that you will not transfer this asset for another 8 years. And in year 2, you have violated the condition. So in year 2, what you need to do is, the deduction that you have claimed is how much? 10 lakh. From that, you can remove notional depreciation. What is notional depreciation? For one whole year, you have used that particular building for your business. So that you can deduct notional depreciation for 1 year. And for building, the rate of depreciation is how much? 10%. So you can deduct 1 lakh rupees from this. The rest of 9 lakh have to be treated as your income, business income. The rest of the 9 lakhs have to be treated as your business income under 35 AD. And the same 9 lakhs will be treated as the actual cost of the asset for the normal business. And from the same 9 lakh, you can claim depreciation in future. Because from year 2 onwards, it is an asset which is used for your normal business. So your normal business can capitalize that value which is taxed in the specified business. And your normal business can charge depreciation in future as well. Are you with me? Are you with me? Let me ask you one doubt. If I am transferring this in year 3, then what to do? 2 years notional depreciation I have to remove. The rest of the value will be treated as my income taxable under 35 AD, and the same value I can capitalize as my actual cost of that particular building for my normal business, and I can charge depreciation in future. Is that okay? And what if I am transferring that particular asset to my normal business after 8 years? Nobody have no problem. For 8 years you use it for specified business. Thereafter you do whatever you want. But if you sell it outside, you have to compute the profits. I hope you remember section 28. If you sell it outside, whatever amount that you get will be taxed under section 28, charging section that we have already covered. Are you with me? The first day, charging section 28, where you have claimed a deduction under 35 AD and you are selling it outside, whether it is within 8 years or after 8 years, whatever amount that you are getting at the time of sale have to be an income taxed under section 28. Moving on, note number 1. Loss from specified business can be set off against only from profits from another specified business, irrespective of whether the latter is eligible for deduction under 35 AD or not. Very simple. When you claim all the capital expenditures as a deduction, definitely you will end up in loss. That loss you can adjust only with specified business, not with a normal business. Specified business loss can be adjusted only with specified business profits, not with the normal business profits, not with the normal business profits. Are you with me? So, where were we? Loss from specified business can be set off only with profits with specified business. Now, such loss shall be carried forward how many years? Indefinitely for set off against profits of the same or any other specified business. You can carry forward it to unlimited subsequent years. There is no restriction for the carry forward. Now, there is one interesting thing. See, for every specified business in the Income Tax Act, there is a commencement date. Only after that day, if they commence, they will get the deduction under 35 AD. You don't have to by heart these dates. That's why I've given it as a separate table. Don't by heart these dates. It's useless. Say for example, building and operating anywhere in India a hotel of 2-star or above. It is considered as a specified business only if you start that business on or after 1st April 2010. Likewise, for every business, there is a notified date. You don't have to study all this notified date and all. Now, there is another thing. Say you are an existing business. Say you are an existing 5-star hotel. For 5-star hotel, from which date onwards you will be considered as a specified business? From 1st April 2010. Okay. See, you are an existing 5-star hotel. On today is 1st April 2010. Today only you came to know that if you start today, you will get 35 AD. But I have already started my business. So what I did, I closed my business. Then I opened the same by calling it as a new business. It is a reconstitution of existing business. You will not get 35 AD deduction. Now the question is, what is the criteria whether it is a reconstituted business or a new business? 80% of the plant and machinery should be fresh, should be new. If you are saying that you are a new business, then 80% of the plant and machinery should be what? New. That means you can use 20% second-hand plant and machinery, no problem. But 80% of the plant and machinery should be new. If 80% of the plant and machinery is new, then government will call you as a fresh, a newly constituted business. These and all are actually not necessary for our exam, so I am not planning to cover it in detail. These are the other conditions. So this is the thing. If you transfer the asset within 8 years, if you are transferring an asset from your one business to another within 8 years, the consequences are explained over here. So these are the things that you must study under section 35. So friends, the next deduction after 35 AD is section 35 CCA. We are about to discuss certain small deduction, 35 CCA, CCC, CCD, 35D, etc. So out of that list, first one is section 35 CCA, and let's understand what exactly is this section 35 CCA. What they are saying is, if you are a person and you are contributing something for notified rural development and urban poverty eradication, you are donating some amount for the benefit of, or you are donating some amount to what? To a rural development fund set up and notified by the central government. You are donating some amount to what, friend? Rural Development Fund, which is set up by the central government, or you are contributing to National Urban Poverty Eradication Fund. You are contributing some amount to where? National Urban Poverty Eradication Fund, again which is notified by the CG. So two types of CG funds are there. Number one, Rural Development Fund or National Urban Poverty Eradication Fund. If you are donating money to any of these funds, whatever amount that you have donated is allowed as a deduction under section 35 CCA. There is nothing complicated over here. How much ever is your donation, that much amount you can claim as a deduction under section 35 CCA. This is what the department says. And there is one note under this. What is that? Where deduction in respect of such expenses is allowed under this section, then no deduction in respect of such expenditure shall be allowed under any other portions of the Act in the same or any other assessment year. That means For a single donation, only one deduction. You have donated some amount, you have claimed it as a deduction here. Thereafter, for the same amount, you are not supposed to ask for another benefit in any other portions of Income Tax Act in this year or in any of the future years. So, whenever you are contributing something to a rural development fund or a National Urban Poverty Eradication Fund, which is set up by the central government, that amount you have donated is allowed as a deduction. And one more thing is there, it is not necessary that the amount that you have donated and your business should be connected. Your business and this donation might have no connection at all, but no problem, you can still claim it as a deduction under section 35 CCA. Moving on to the next deduction, small deduction, that is 35 CCC. And tell me friends, what is section 35 CCC? Deduction in respect of expenditure incurred on notified agricultural extension project. Say for example, you are a person to guide, train or educate farmers in India. You thought of initiating a project. You are about to teach these farmers the new techniques, new technology. Alright, so to teach, guide or educate farmers in India, you have conducting a project. You are conducting a program. Okay. And this program should be notified by the Ministry of Agriculture. That means the central government should notify this particular project. So, when you are conducting such a project, you will incur some cost. Yes or no? Whatever cost you incur, department say you claim it as a deduction under section 35 CCC because you are doing a good initiative. So, let's understand what is 35 CCC in a detailed manner. That is deduction in respect of expenditure incurred on notified agricultural extension project. And what are they saying under 35 CCC? A deduction of a sum equal to 100% of expenditure is allowable. Whatever amount that you have incurred to carry out that project, that entire amount you can claim as a deduction. Then the project shall be undertaken for training, education and guidance of the farmers. The main objective of that particular project is to train, educate and guide the farmers in India. Such project should have prior approval of central government. So that project should have what? Prior approval of central government. To be very precise, from the Ministry of Agriculture, you should have an approval. Now, an expenditure not being expenditure in the nature of cost of any land or a building exceeding amount of 25 lakhs is expected to be incurred for the project. Smaller amount project or smaller project, you will not get any deduction. You have to minimum expend more than 25 lakhs. Not even exactly 25 lakhs, more than 25 lakhs. You have to expend more than 25 lakhs, then only you will get that amount as a deduction. And there is one more thing. See, 25 lakhs is actually a huge expenditure. So you thought of buying a land, developing the land, then constructing a building. Thereafter, you are conducting a one-day project. Are you with me? Can you consider the cost of land and building as a cost of project? No. When you count the cost of project, you are not supposed to include the cost of land and cost of building. Cost of project means all other expenses excluding cost of land and cost of building. And for land and building, you are not supposed to claim any deduction. That's what the department is saying. So, excluding the cost of land and cost of building, you should minimum incur how much? 25 lakhs, more than 25 lakhs for claiming it as a deduction under section 35 CCC. Now, assessee maintain separate books of accounts of such notified agricultural extension project and get such books of accounts audited by a chartered accountant. So, two things are there. You have to maintain books of accounts and you have to carry out tax audit. Now, and furnish the same on or before due date of furnishing your return of income to the Commissioner of Income Tax or Director of Income Tax. You should submit everything, your audit report and other thing, just before the due date. To be very precise, 1 month prior to the due date of submitting your return. That is the exact date to submit your audit reports. So this is what the department normally says. So another shorter deduction, it was section 35 CCC. And you tell me what is section 35 CCC? Very simple. You are incurring a project which to guide, train, educate farmers in India. And whatever the cost that you are incurring in relation to that particular project is allowed as a deduction under section 35 CCC. That's what the department says, and I hope it is clear for you. Moving on to the next deduction in this lot, another simple item, that is section 35 CCD. And let's understand what exactly is this section 35 CCD. Listen. So, what are they saying? Deduction in respect of an expenditure incurred by company. So here one thing you have to be very careful. Only company assessees will get this deduction. And that too, you have to incur some amount for a project which is connected with skill development. So 35 CCD, you have to be a little bit careful. Assessee have to be what assessee? Company assessees are only eligible to claim 35 CCD deduction. Other assessees technically cannot claim 35 CCD. So only company assessees can claim deduction under section 35 CCD. And company assessees, what should they do? Company if invest in skill development project in manufacturing sector, that simply means, say you are conducting a project that is connected with skill development. Okay, you are conducting a skill development project which is in relation to manufacturing sector. That means you are conducting a kind of a training program where people can come and learn some skills. So a deduction of the sum equal to 100% of the expenditure. Whatever expenditure that you incur for running that project, that entire expenditure is allowed as a reduction under section 35 CCD. But one thing is there, that project cost should not include cost of land and cost of building. Whatever cost incurred for the project excluding cost of land and cost of building is allowable as deduction. Here there is no minimum expenditure like 35CCC. 35CCC says that you should expend minimum more than 25 lakhs. Here there is no such criteria. On notified skill development project incurred by the company in accordance with the prescribed guideline. So that notified skill development project should be in accordance with the prescribed guideline. Normally you will have a tie-up with NSDC, National Skill Development Corporation. Then here also for claiming deduction, assessee must maintain separate books of accounts of skill development project and get such books of accounts audited by a accountant. Here also accountant means chartered accountant. Now moving on, furnish the same on or before due date of furnishing return of income to the Commissioner of Income Tax or Director of Income Tax. So similar to 35CCC, they are also in 35 CCD says that separate books of accounts is required, and that separate books of accounts should be subjected to what? Audit as well. Then only you can claim a deduction under 35 CCD. So which are the important criteria under 35 CCD? You should be a company assessee and you should incur a cost to run a skill development project. If you sorry, which is connected with manufacturing sector. Then if you are doing that, then all the cost of that particular project excluding cost of land and cost of building is allowable as deduction under 35 CCD. So three deductions in a row: 35 CCA, CCC, CCD. Moving on to the next item, that is 35D, amortization of preliminary expenses. Let's understand what is this amortization of preliminary expenses. Another simple deduction. Tell me friends, what do you mean by preliminary expenses? Not incorporating a company, before commencing business, whatever expenditure that you incur is said to be what? Preliminary expenses. Before commencing business, whatever expenditure that you are incurring can be called as what? Pre-commencement or preliminary expenses. In accountancy, what do you do with the preliminary expenses? You normally, we cannot say capitalize, you accumulate it and you claim it as a deduction in different years. You amortize that particular expenditure. Are you with me? You accumulate it, then you amortize it. Normally these kinds of expenditures are treated as a deferred expenditure. You will accumulate and keep on claim, amortize it in different years. In income tax, what you need to do, department say you have to follow 3 steps. You have to follow what? 3 steps. Step number 1, identify eligible preliminary expenses. You need to follow 3 things while claiming deduction under 35 CCD. Step number 1, you need to identify eligible preliminary expenses. From that, one thing is very much clear. For all preliminary expenses, you will not get a deduction. Only for eligible preliminary expenses, you will get a deduction. Number 2, you need to check whether this eligible preliminary expenses total is within ceiling limit. So, check whether it's within ceiling limit. You take the total of the eligible preliminary expenses, then you need to check whether it is within the ceiling limit. Then what is step number 3? Such expenditure allowed as deduction in 5 equal annual installments. So such expenditure which is within the ceiling limit have to be claimed in 5 equal annual installment, or you can amortize it in 5 equal annual installment from the year of commencement. From the year of commencement. That's what the department say. So 35D, amortization of preliminary expenses, you must follow 3 main steps. What is step number 1? Identify eligible preliminary expense. Step number 2, check whether it is within the ceiling limit. Step number 3, check that expenditure which is within the ceiling limit is allowed as a reduction in 5 equal annual installment from the year of commencement of your business. So let's have a detailed discussion on what all are the eligible preliminary expenses. That is the first thing that we are about to discuss. What all are the eligible preliminary expenses? So let's understand eligible preliminary expenses one by one. So please listen. Number 1, what are they saying? Item number 1, they say the following expenditures are eligible for amortization. Expenditure in connection with number 1, preparation of feasibility report. What do you mean by feasibility report? Say if you are about to start a business, whether that business is feasible in that particular market, whether that product you can offer will become successful, whether this product can be commercialized. So the feasibility study everybody normally does before investing a huge amount. So if you are conducting a feasibility study, all the related cost is allowable as a eligible preliminary expenses. So preparation of feasibility report. Number 2, preparation of project report. What is project report? How much you should invest. If you invest this much, when you will get it back. You might have heard about IRR, internal rate of return. If I am investing this much amount in year 0, then from year 1 onwards, I will get what? Cash inflows. I have to discount that cash inflows, then I have to check when that discounted cash inflow is equal to the investment in year 0. Yes or no? These are basically projections. Based on the projections only, we prepare or we decides how much we have to invest. So, preparation of project report everybody does before investing a huge amount. So, that also is an eligible preliminary expenses. Then point number 3. What is point number 3? Conducting market survey or any other survey. What should be the type of product that you have to offer? For that, you should understand the preferences of the customers in the market. So, if you are conducting a market survey or any other survey, whatever cost that you incur for conducting the market survey or any other survey is again allowable as an eligible preliminary expenses. So, conducting market survey or any other survey to understand the customer taste so that you can design your product accordingly. So, everybody does this. So, all the cost that you have incurred to conduct this market survey or any other survey is another eligible preliminary expenditure. Point number 4. What is that? Engineering services are related to the assessee's business. The assessee need to set up the entire building, plant and machinery and the other thing. For that, he require a lot of engineering support. So, all the engineering services in relation to assessee's business is again allowable as an eligible preliminary expenses. Then, what is the next one? Legal charges for drafting agreement. What is that? Say for example, whenever you are about to start a business, at least there will be some rental agreements. You should rent out that particular building, etc., etc. So, for all the legal charges for drafting any initial agreements is again an eligible preliminary expenses. For rental agreement, registered lease, etc., you have to incur some legal charges. So, whatever legal charges that you are incurring for drafting any agreement in the initial period is again an eligible preliminary expenditure. Then, point number 6, what is that? Legal charges for drafting MOA and AOA. You know what is MOA, Memorandum of Association. You know what is AOA, Articles of association. So whatever drafting charges incurred for MON, AOA is another eligible preliminary expenses. Next one, point number 7. Printing of MON, AOA. Printing charges of MOA and AOA is another eligible preliminary expenses. 8th one, fees for registering the company, the incorporation fees. Whatever incorporation fees that you incur, that is another eligible preliminary expenses. And the last one is what? Underwriting commission. What is underwriting commission? To achieve minimum subscription, you will appoint underwriters. That underwriters will make sure that shares are subscribed by the shareholders, or they themselves will subscribe for it. For that, you have to pay a commission to the underwriters. So all the underwriting commission that you are paying before the commencement of business in relation to issue of shares or debentures, that to public issue of shares and debentures, is allowable as a eligible preliminary expenses. Likewise, all the common brokerages, you appointed a broker. All the brokerages is allowable as a deduction. And finally, drafting and printing expenses of prospectus. Say, you need to draft prospectus whenever there is a public issue of shares or debentures. So all the drafting charges, printing charges, and its advertisement is allowable as a eligible preliminary expenses. So 9 eligible items are there. Out of that 9, 6 to 9 is only for companies. Not 6 and 9, 6 to 9. Check. Number 1, legal charges for drafting MOA and AOA, printing charges of MOA and AOA, registering the company, and shares and debentures. These are only incurred for company SCs. 1 to 5 is common for everyone. Are you with me? Including companies. So that was step number 1. And you tell me, what was step number 1? Identify eligible preliminary expenses. We have identified all the eligible preliminary expense. Now you need to take the total of this 9 items. Then you need to check whether it is within ceiling limit or not. For checking whether it is within ceiling limit or not, in the case of a resident non-corporate assessee, what do you mean by resident non-corporate? You are not a company. Other than company assessees who are residents in India, ceiling limit shall be 5% of the cost of project. If you are a person resident other than a company in India, then the ceiling limit shall be 5% of the cost of the project. What is ceiling limit? See, you take the total of 9 items. The total of 9 items shall never exceed 5% of the cost of the project. Now, what is this cost of project? Cost of project means amount invested in total fixed asset. That is the actual cost of fixed asset of new project or extension of business or setting up of a new unit as per the books of accounts on the last day of previous year. You simply take the actual cost of all the fixed asset. That will be considered as the cost of project. Are you with me? Are you all listening? You simply take the total value, actual cost of all the fixed asset. That total value shall be the what? The total value shall be the cost of the project. Good. Now, what if you are an Indian company? 5% of the cost of the project is for resident non-corporate assessee. You tell me, what if you are an Indian company? Then how do you identify the cost of the project? Sorry, how do you compute the ceiling limit? Department say 5% of the cost of the project or 5% of the capital employed, whichever is higher. Either you take 5% of the cost of the project. That means total value of all the fixed assets into 5%, or you take what? 5% of capital employed. What is capital employed? Let's see. Capital employed means share capital, debentures, long-term borrowings as on the last day of the previous year. Reserves and surplus shall not be included in the capital employed. So you take the share capital plus debentures and long-term borrowings. That total is said to be the capital employed. Don't add any reserves and surplus like securities premium. You are not supposed to add when you compute the capital employed. That's what the department say. So very simple. For company SSE, you take 5% of the cost of the project or 5% of the capital employed, whichever is higher. Now, we have checked whether it is within ceiling limit. Now, what is remaining? How to claim the deduction? That is in E5, equal annual installment from the year of commencement. You can claim this as a deduction in 5 equal annual installment from the year of commencement onwards. That's what the department says. So 3 steps are there. Number 1, identify eligible preliminary expenses. Number 2, check whether it is within ceiling limit. Then step number 3, what was that? That amount which is within the ceiling limit is allowed as a deduction in 5 equal annual installment from the year of commencement of business. This is what the department says. And there are a few notes under this. Let's understand the notes one by one. First one, audit is mandatory. Assessee is a person other than a company or a cooperative society. The deduction would be allowable only if accounts are audited by a chartered accountant in the year in which such deduction is claimed. That means the first year. And the audit report should be submitted as per section 44 AB. Very simple. Why other than company and cooperative society? Companies and cooperative societies are anyways getting audited. Yes or no? So for other persons, say like an individual or someone, if you are incurring any preliminary expenses, you have to maintain separate books of accounts and get it audited by a chartered accountant in the first year to claim the deduction for preliminary expenses. That's what the department says. Now, in the case of amalgamation or demerger, where undertaking of an Indian company is transferred by an amalgamation or a demerger within a period of above 5 years, then the balance deduction shall be claimed by the amalgamated company or resulting company as the case may be, as if the amalgamation or a demerger has not been taken place. What is that? Listen, say this eligible preliminary expenses, if it is within the ceiling limit, then it is allowable as deduction in 5 equal annual installment. Yes or no? First 2 years, you have claimed the deduction, you have amortized. Third year, there was an amalgamation. So your entire activities have been taken over by a amalgamated company. Are you with me? Your entire activity have been taken over by whom? Amalgamated company. So what happened is, now 2 installments were claimed by the amalgamating company. The remaining 3 can be claimed by amalgamated company. That's what the department says. Same in the case of demerger. If 2 installments claimed by the demerger company and there is a demerger, then the resulting company can claim the balance number of installments as if there was no demerger or as if there is no amalgamation. If nothing happened, how do you claim? The balance number of installment is claimed by the successor. Whether it is amalgamating company or resulting company doesn't matter. That's what they are saying. Now, to the last one, statement to department. What is that? The assessee has to furnish a statement containing the particulars of above expenditure within 1 month prior to the due date of furnishing return of income as specified under section 139 subsection 1. So assessee have to give a detailed statement on what all are the expenses that you have incurred. Are you with me? To the department, that statement have to be submitted before 1 month prior to your due date of filing return. That's what the department say. So these are the main things under 35D. So can you have a plain reading of a 35D, friends? So friends, moving on, there are certain notes which are actually important for our exam perspective, and let's understand this note one by one. So there is a chart. It's actually important, okay? So treatment of certain expenses before commencement and after commencement. If you are incurring certain expenses, if you incur that expenses before commencement, what is the treatment? If you incur that expenses after commencement, what is the treatment? This is what we are about to discuss right now. So let's understand what if you incur these expenses before commencement and after commencement. Starting with the first one, share issue expenses, including right shares. Say you are issuing some shares, whether it is fresh issue or right shares. If it is incurred before commencement, then allowed as a reduction under 35D. Hope you remember, underwriting commission, brokerage and printing, drafting and advertising of prospectus is allowed as a reduction if it is before the commencement. Are you with me? So share issue expenses including right shares, if it is incurred before commencement of business, is allowed as a reduction under 35D. No problem. What if it is incurred after commencement? Not allowable under section 37, because what department says is, it's not department, it's Supreme Court says. Supreme Court in the case of Group Bond India, what they are saying is, say when there is a share issue after commencement, that share issue means it is a capital funding. It's a fundraising event. Yes or no? So it is company are actually raising their own funds. So whatever expenses for raising your own fund cannot be allowed as a business expenditure. That is a kind of an internal expenditure. That cannot be allowed as a business expenditure, specifically under section 37, because 30 to 36 does not cover share issue expenses in the post commencement phase. So the only way is 37. 37 an expenditure should be a business expenditure to claim it as a deduction. An expenditure you should incur to earn profit. So here what they are saying is, it is an expenditure to increase your capital, raise your capital. That is a kind of an on funding happening. So that expenditure we cannot allow it under section 37. That was the verdict given by the Supreme Court. So what we can conclude is, share issue expenses, if it is before commencement, 35D specifically considers that. So you can claim it as a deduction. Share issue expenses after commencement, no other section vouch for it, and hence you cannot claim it as a deduction. Then expenditure on issue of bonus shares. How about expenditure on issue of bonus shares? Pre-commencement phase is not applicable. Why? First of all, you have to start a business, earn some profits, then only you will be able to issue bonus shares. So for bonus shares, there won't be any pre-commencement error. How about post-commencement? Allowed as deduction under 37. Why? Because of the Supreme Court judgment in the case of General Insurance Corporation. What they are saying is, see, in the post-commencement era, bonus shares is just like an administrative expenses. What is administrative expenses? It is just like capitalizing your profits. There is no fresh inflow of fund. So it's not a fundraising event. And hence, it is considered as an administrative activity. And hence, you can claim the expenses in relation to bonus shares are a deduction. It can be claimed as a deduction under section 37. So the point is simple. Expenditure on issue of bonus shares are allowed as a deduction. No problem whatsoever manner. Then, what is next? Debenture issue expenses. Before commencement, allowed as deduction under 35D. How about after commencement? 37. Why? Because debenture is an external debt. When you are about to take an external debt, definitely that is considered as an external activity, that is considered as an expenditure. Hence, you can claim it as a deduction under 37. Again, Supreme Court. Which case? Core Healthcare. And finally, one more thing. Expenditure incurred on issue and collection of convertible debentures. What is convertible debenture? Today it is debenture. Tomorrow it will become equity share. So when you are issuing a convertible debenture, at the time of issue it's an external debt. Hence it is allowed as a deduction. Set by ITC Limited, again in the case of set by the Supreme Court, again in the case of ITC Limited. Okay, that's not important. That's why I haven't mentioned the name of the case. So expenditure and allowed as deduction under 37. So issue and collection of convertible debentures are also allowable as post commencement expenditure under section 37. It has been tested as adjustments in exam. It has been tested as what? Adjustments in exam. So that's why I told you to mark it as important. Moving on. We have completed section 35D. Now we have more expenditures to complete. That is section 35DD. Amortization of expenses for amalgamation or demerger. Let's understand. Say you are an Indian company. Incurs expenditure wholly and exclusively for the purpose of amalgamation or demerger. Then the deduction shall be allowed in 5 equal annual installments. Very simple. Whoever incurs an expenditure in relation to an amalgamation or demerger, then that person who incurred that expenditure, that person can claim it as a deduction under 35DD in 5 equal annual installment. Again, one more thing is there. If amalgamating company is incurring that expenditure, after amalgamation, the balance number of installments can be claimed by the amalgamated company. Because after amalgamation, there is nothing called an amalgamating company. Everything have been taken over by the amalgamated company. Yes or no? And hence we can say, if the expenditures are incurred by the amalgamating company, then balance number of installments always after amalgamation can be claimed by the amalgamated companies. That's it. So 35DD, amortization of expenses for amalgamation or demerger. Moving on. Section 35DDA, what is that? Amortization on expenditure incurred under voluntary retirement scheme. Say, listen. So friends, you tell me, what do you mean by voluntary retirement scheme? Say a person, say you are a company or you are an employer. One of your employees is getting retired before his age, before his retiring age. That event is normally called as what? Voluntary retirement. He himself is retiring even before his retirement age. So when he retires, what the employer should do? Say tata? No, the employer should pay an amount. We call it as voluntary retirement compensation or a voluntary retirement sum have to be given by the employer to the employee. Now, for the employer, it's actually a cost. Yes or no? Because he is making a payment, a lump sum payment to his employee. So for the employer, it is actually a cost. And the employer can claim that cost as a deduction in 5 equal annual installments. So deduction for expenditure shall be allowed in 5 equal annual installment. If you are making a payment which is connected with voluntary retirement, that lump sum payment that you have made is allowed as a reduction in 5 equal annual installment. And here also there is one thing. In the case of an amalgamation, demerger, business reorganization, succession, etc., within that 5-year period, then the successor can claim balance number of installments. Say the amalgamating company have paid a voluntary retirement compensation to 1 or 2 of its employees. After 2 installment, before the 3rd installment, there was amalgamation. Then 3rd, 4th and 5th installment deduction will be allowable for amalgamated company. The successor can claim the balance number of installment, or the successor can claim deduction for the balance number of installments. Are you all with me? Isn't it very simple? 35DDA, amortization of expenditure incurred under voluntary retirement scheme. Super. So moving on to the next one. Next one I can say again unnecessary for our exam, 35E, amortization of expenses for prospecting and development of certain minerals. Again unnecessary for our exam. So if you have that much time only, you focus on section 35E, otherwise you can easily skip section 35E. Next is the lengthiest section that we are about to discuss in this chapter, section 36, other specified deductions. It's actually pretty long and there are a lot of things that you have to study under section 36, other specified deductions, or we can say the last specified deduction. Why? Next is 37. That is not specified deduction, that is general deduction. So this is the last specified deduction. And without wasting time, let's understand what is this last or other specified deductions under section 36. Number 1. Under section 36, what is the first one? Insurance premium paid, that is under section 36 subsection 1 clause number 1. Let's understand what exactly is this. Insurance premium paid on stock or stores of the business or profession is allowed as deduction. What do you mean by this? Say on your stock in trade or raw materials, you have taken an insurance. If you have taken an insurance, you have to pay what? Premium. The premium that you have paid is allowed as a deduction under section 36. On your stock in trade or on the value of your raw material, that means stores or consumables, you have taken an insurance. That the premium that you are paying for that insurance is again allowed as a deduction. That's what the department says. Are you all here? Is that point clear? Super. So insurance premium paid on stock or stores of a business or profession is allowed as deduction. That is point number 1. And let's understand what is point number 2. Say insurance premium paid by a federal milk cooperative society, that is deduction, is allowed in respect of amount of premium paid by a federal milk cooperative society to effect or keep in force an insurance on the life of cattle owned by them. Say you are a federal milk cooperative society and you have taken a life insurance on the life of your cattle. Have you seen certain cows wearing a kind of a stud yellow color stud in their ears. Do you think it's a kind of a jewelry? No, it's not jewelry, it's basically insured cow. Okay, so if you are a federal milk cooperative society and you have taken a life insurance on the life of your cattle, the premium that you are paying is allowed as a deduction under section 36. That's what the department says. Pretty simple point. Deduction is allowed in respect of amount of premium paid by federal milk cooperative society to the effect or to keep in force insurance on the life of cattle owned by them is allowed as a deduction. Moving on to point number 3, let's understand what exactly is point number 3. Again, it's an insurance premium. Premium paid by employer for health insurance of employees. Premium paid by whom? Employer. Mode of payment should be other than cash. And the premium should be connected with what? Health insurance of employees. Say for example, the employer have taken a group health insurance for the benefit of all the employees. If you have taken a group health insurance for the benefit of employees, then you have to make the premium. You have to pay the premium. That premium paid by the employer is allowable as a deduction under section 36. Very simple. But there is one condition for that. What is that? The mode of paying premium should be other than cash. You are not supposed to make cash payments. If you are making cash payment, you will never get it as a deduction. That's what the department says. Are you all here? Yeah. So moving on, what is next? We have completed 3 items. All those 3 items are what? Insurance premium only. Yes or no? First one, stock and stores. Second one, Federal Milk Cooperative Society on the life of cattle. Third one, employer on the health insurance of employees. Moving on to the 4th item, and let's understand what exactly is 4th item. 4th item is again pretty simple. That is bonus and commission paid by the employer to the employee. Bonus and commission. Bonus and commission actually paid by the employer to the employees. Say, I am an employer and I am paying what? Bonus for the benefit of my employees. Or I am paying commission or giving commission to my employees. Both the bonus and commission, both are allowable as a deduction under section 36, subsection 1, clause number 2. It is subjected to 43B that we will discuss later. That means actual payment is mandatory. Even if you maintain books of accounts in mercantile system, you cannot put a payable entry and claim a deduction. Not possible. Actual payment is mandatory. That's what subjected to section 43B. Moving on. That we will discuss later. Okay. So point number 5. What is point number 5? Interest on borrowed capital. What does that mean? Say you have taken a loan for your business or profession. If you have taken a loan, then you have to repay that loan. At the time of repayment, you have to pay interest element. If you are paying that interest element, that is your business expenditure. If it is the business expenditure, then it should be allowed as a deduction. It is allowed as a deduction under section 36, subsection 1, clause number 3. Pretty simple. Deduction of interest is allowed in respect of capital borrowed for the purpose of business or profession. For this point, we can add one exception. Hope you remember. When you are purchasing a capital asset by taking a loan and the capital asset requires some period till it's put to use, whatever interest that you have incurred up to put to use, that proportionate interest have to be capitalized. That means that proportionate cost have to be added with the actual cost of that respective asset. Yes or no? So that is the only exception. Apart from that, all other interest costs which are where we have taken a loan in connected with your business or profession is allowed as a deduction under 36. Interest paid on loan for acquiring a capital asset shall be capitalized till such capital asset was first put to use. Thereafter the same shall be allowed as a deduction under section 36 subsection 1 clause number 3. Super. Point number 6. Not point number 6, there is actually a note. Okay. In the case of a genuine business borrowing, department cannot disallow any part of the interest on the ground that the rate of interest is unreasonably high except in case falling under section 40A subsection 2. When you are paying excessive interest to your relatives or associates, that will be a problem. If you are paying excessive interest to other persons, that shouldn't be a problem because at times you will not get loan. You will go to some private lenders then they will ask for high rate of interest. If paying that high rate of interest, that is not a crime, not a problem. You can claim that entire interest cost as a deduction. Are you with me? Superb. So point number 6, friends. Let's understand what is point number 6. Very simple. Discount on zero coupon bond. What is zero coupon bond? Zero coupon bond is a bond where there won't be any annual interest, but it will be always issued at discount. Are you with me? Zero coupon bonds are normally issued at what? Discounts. So let's understand what is this zero coupon bond. Listen, say for example, there is a company and that particular company is issuing a bond, okay, having a face value of say 10 lakhs. And they are issuing this bond for only 7 lakhs. So whoever invests, we will call investor, have to pay only how much? 7 lakh rupees to the company to get that particular bond. So you have to pay only rupees 7 lakh for that particular bond. Say the bond is for 3 years. After 3 years, the company have to repay how much? 10 lakh rupees to the investor. At the time of maturity, the investor will get how much? 10 lakh rupees. So you tell me, throughout the period of bond, how much is the cost for the company? It is, the total cost of the company is only 3 lakh because the company received 7 and they repaid 10. So the total cost in relation to the issue and maturity is how much? 3 lakhs. That is said to be the discount on zero coupon bond. This is allowed as a deduction. Allowed as deduction for the company under section 36 on a pro rata basis. What is pro rata basis? The bond is for 3 years. Total discount is 3 lakhs. So 3 lakh divided by 3 years. Every year you can claim a deduction of how much? 1 lakh each. Whenever you issue that bond, year 1, 1 lakh, year 2, 1 lakh, and the maturity year 3, 1 lakh. So the discount on zero coupon bond is allowed as a deduction on a pro rata basis having regard to the life of bond. That's what section 36 states about. Are you with me? Let's understand. Deduction for the discount on zero coupon bond available on pro rata basis having regard to the period of life of the bond to be calculated. And there is one note. The period commencing from the date of issue of the bond and date of ending of the bond of the maturity or redemption. So the period of life means period commencing from the date of issue till its maturity. Note number 2. If any calendar month part is 15 days or more, then it shall be increased to 1 calendar month, and if such part is less than 15 days, it should be ignored. That means it is not like strictly 3 years. Maybe it can be say 36 months and 18 days. Say it is 36 months and 18 days, you have to consider 37 months. If it is 36 months and 10 days, round it up to 36 months. So 15 days or more part is there, then consider it as 1 full month. If it is 15 days or less, then you round it backwards. So if the zero coupon bond, there is an example also for this, okay, that you can read it by yourself. So discount on zero coupon bond is allowed as a deduction on a pro rata basis having regard to the life of that particular bond. That's what the that's what the department says. Now listen, imagine from the perspective of investor. Here the investor is also getting a gain. What is that gain? He is getting 10 lakhs back and his cost of acquisition is only 7 lakh. So what will happen to the 3 lakh? That will be taxable as capital gains. Because zero coupon bond is a capital asset and redemption of zero coupon bond is considered as a transfer. And hence whatever gain that the investor get in between that maturity and issue shall be taxable under capital gain. This is what the department says. Are you with me? This has no connection with 36. I will explain the investors part as well. That's it. Moving on. So that is point number 6. And what is point number 7? Contribution to Provident Fund and other fund. Whose contribution? Employers. See, To every provident fund, both the employer will contribute, employee will contribute. Yes or no? So the employer's contribution is actually a cost for the employer because he is contributing it from his own pocket. Are you with me? That contribution should be allowed as a deduction. And the section is 36, subsection 1, clause number 4 and clause number 5. Employer's contribution to the employees recognized provident fund, approved superannuation fund, or any approved gratuity fund are allowable as deduction. If the employer contributes anything to the employee PF, it should be RPF. What is RPF? Recognized provident fund, or it should be an approved superannuation fund, or it should be an approved gratuity fund. You are contributing something for the benefit of your employee, then that contribution is your cost and it is allowed as a deduction under section 36. That's it. Moving on. Point number 8. What is that? Employer's contribution to the account of employee under a pension scheme referred in section 80CCD. If the employer is maintaining NPS, National Pension Scheme, which is mentioned under 80CCD of Income Tax Act. It's called as NPS, National Pension Scheme. To the pension fund also, both the employer as well as the employee have to contribute. Are you with me? To the pension fund also, both the employer as well as the employee have to contribute. If the employer and the employee contributes to pension fund, then for the employer contribution, it's actually a cost because he is contributing from his own pocket. That is allowable as a deduction under section 36, subsection 1, clause number 4A. But there is a ceiling limit. Deduction could be restricted to how much? 14% of salary. Earlier it was 10% of the salary. Now they have increased that limit up, made it up to 14% of salary of the employee in the previous year. So right now you need to be careful that percentage is not 10, it is 14 right now. Yep. So 14% of salary of the employee in the previous year. Now what is the salary? Salary here means basic salary plus DA forms part of the retirement benefit. What is DA? DNS allowance. That forms part of the retirement benefit. Excess shall be disallowed under section 40A9. If there is any excess contribution over and above 14%, then that excess shall be disallowed in the hands of the employer. So the employer have to make sure that he is paying only 14% of the salary. Otherwise, he will never get it as a deduction. But to PF and all, there is no such ceiling limit for the employer. He can contribute whatever he wants and he can claim it as a deduction. But to NPS, there is actually a ceiling limit, and maximum ceiling limit is 14% of basic plus DA that forms part of the retirement benefit. If excess contribution is there, then that shall be disallowed under section 40A9. I hope it is clear. So moving on with the next deduction under section 36, that is an interesting one, item number 9. What is that? Amount received by assessee as contribution from his employee towards the welfare fund to be allowed only if such amount is credited on or before due date. Listen, see, we'll take provident fund as an example. Okay, towards provident fund, both the employer as well as the employee will contribute. Who will contribute? Employer will contribute. And who also will contribute? Employee also will contribute. But employee will not make any direct payment to PF. The employer will deduct what? Payment from his salary. So whenever employer pays salary, there will be a cut. Employee's contribution will be deducted by the employer. Are you with me? This deducted amount will become employer's income under section 224, clause number 10. This will become employer's income. Thereafter, if the employer is correctly making the payment, that deducted amount, if the employer is making on or before due date of PF Act, if that employer is making that payment to the respective fund on or before due date of not filing return, due date of the corresponding act. If it is PF, PF Act. If it is ESI, corresponding act. So then he can claim it as a deduction. So it is not your income, not your expense, but we will treat it as your income as well as your deduction. Why? Because you have to correctly cut the amount and you have to correctly make the payment, that too on or before due date of the corresponding act. Whenever we say due date, automatically due date of filing return, don't say that. Okay, it is due date as per the corresponding act, PF Act or ESI Act or whatever it is. Are you with me? So, let's understand the theory. What are they saying? So, such contribution from the employee is treated as income of the employer under section 224 clause number 10. Subsequently, when such sum is credited by the employer to the employee's account in the relevant fund on or before due date of its crediting such contribution prescribed under relevant act, then deduction is allowed. So, not as per PF Act, it shall be paid within 15 days of closure of every month. So, this month's cut have to be paid before 15th of next month. So, on that day itself, you have to make the payment. What if there is a delayed payment? It is disallowed forever. If there is a delayed payment, then that income will be your income and you cannot claim it as a deduction. Subsequently, you actually made the payment to that respective fund, doesn't make any difference. Miss the date, you will miss the deduction. It is like that. Moving on to item number 10. Let's understand what is item number 10, that is allowance for animals. Say you are using a live animal for your business. You are using what? A live animal for your business. Say you are using an elephant for your business. Now, can you capitalize that elephant's cost and claim depreciation? Not possible, because elephant is not a specified asset. Under depreciation, I have clearly mentioned that if it is a specified asset only, you can, if that asset comes under the specified 5 categories only, you can claim a deduction. So here, animals will not come under any of those specified category. So what you need to do is, say, listen, you purchased an elephant in year 1, okay, by paying 50 lakhs. 50 lakhs was the purchase cost for the elephant. Then in year 5, it expired or it died, okay, or it become useless for your business. Either it got paralyzed or it has died. So if it dies, then what you have done is you have taken its tusks. You have taken its tusks and you've sold it in the market for 10 lakhs. You sold it in the market for what value? 10 lakhs. So what is your effective cost? Initial purchase cost was 50. In the year in which it becomes useless, you took the tusk and sold it in the market and you recovered 10. So what is the effective cost? 40 lakhs. So this 40 lakhs shall be your effective cost and it is allowed as deduction under section 36 in the year in which that elephant becomes useless. So in the year of purchase, you cannot claim any deduction. The year in which that animal becomes useless, you can claim that effective cost. What is effective cost? The original purchase cost minus whatever recoveries from that sale of carcasses, we will say. Carcasses means remainings. If you are getting something back from its remainings, you need to net it off. Only the remaining net effective cost is allowed as a reduction in the year in which that animal become useless. So go back to the theory. Let's come back to the theory. What they are saying is, an allowance in respect of animals which have died or become permanently useless. An amount of allowance is the difference between the actual cost of the animal and the price realized on sale of animals themselves or their carcasses. If you are selling that animal, when it becomes old, you are selling it for a lower price than the effective cost. You can claim it as a reduction. Or it becomes useless and you are selling it and you are getting some remainings, some amount, just like a scrap. Normally for animals, we don't say scrap. So we say carcasses. That means remainings. So cost of life animal minus scrap value is only for your understanding. Okay. I have not intended to call an animal as a scrap. You cannot technically call animals as a scrap. Coming back to the point, friends. So we were discussing about allowance for animals. Then point number 11, what is that? Bad debts. What is bad debt? You have done a credit sale and you have shown a person as your debtor, say 10 lakh. He become bad. So at the time of sale, you have shown this 10 lakh as your income. Now he becomes bad. That means he is not supposed to make you the payment. Then you tell me what to do. Very simple. You reverse it. That means you claim it as a deduction because you've already shown it as your income. Now you reverse the effect, you claim it as a deduction under which section? 36, subsection 1, clause number 7. And section 36, subsection 2 is also there. Two sections are there. Let's see. Conditions for claiming bad debts as deduction. Number 1. The debts or loans should be in respect of business which was carried on by the assessee during the previous year. So basically, the debt should have a connection with your business. The debt should have been taken into account in computing income of the assessee. The debt once should have to be your income. So basically, it was your income earlier. Now it become bad. Then it should be actually written off in the books of accounts of the assessee simply by putting a provision for bad and doubtful debts. For bad and doubtful debts, can you claim it as a deduction? No. Simply by putting a provision for bad debt, you cannot claim it as a deduction. You have to actually write off that bad debt in your books of accounts. Then only you will get it as a deduction. Then what is next? Bad debt of discontinued business is not allowed as a deduction even though assessee has any other business continued. Say you had a business, you were running a business earlier. There you have discontinued it. After 2-3 years, you understood that at the time of discontinuation, there was a debtor. That debtor become bad. So can you claim that bad debt as a deduction from your existing business? No. Bad debts of discontinued business, you cannot claim it as a deduction from the existing business. Not possible. So these are the 4 things that you should be careful in relation to what? Bad debts. I hope it is clear. So 4 things are there. You must satisfy all things to claim bad debts as a deduction. Then let me ask you one simple doubt. What if the bad debt that you have already written off in your books of accounts and claim deduction, what if it is recovered? Very simple. Section 41 subsection 4, you show it as your income. Subsequent recovery of bad debts already allowed as deduction shall be taxable under section 41 subsection 4 as income of the previous year in which it is recovered. Very simple. Note number 2. It's an interesting note. Rather than just reading this note, I'll give you an example for this note number 2. Listen. Say for note number 2, what we can say is, say there was a debtor, rupees 10 lakhs in year 1. Okay. So it was, what do you say, not a, the debtor, the total amount was say 10 lakhs. Say in year 2, I called this debtor. And the debtor told me that I don't have 10 lakhs money. I'm not planning to give you rupees 10 lakh. I'll pay you 3 lakh. The debtor told me that he will pay how much? 3 lakh. But he haven't paid 3 lakh. Okay. He told me that he will pay 3 lakh. Will pay. That means 7 lakh is gone. Yes or no? He is supposed to make me a payment of 10 lakh. But he called me and he said he don't have 10 lakh money, but he will try to pay how much? 3 lakh. Okay. So 7 lakhs is gone. So 7 lakh I claimed as bad debt. 7 lakh I claimed at what? Bad debt in year 2. Then in year 3, he came to me and he paid rupees 1 lakh and he told me that it is full and final settlement. He paid me how much? 1 lakh and he told me that it is full and final settlement. Then what should I do? If he is paying me 1 lakh and saying it is full and final settlement, then what to do? Imagine you need to analyze it in full rather than jumping into conclusion by saying 1 lakh should be recovery of bad debt. No, it's not like that. He was supposed to pay you 10. Yes or no? Last year you claimed 7 as what? Bad debt. Now you are expecting 3 from him, but he paid only 1 out of that 3, and hence there will be some more bad debts, that is 2 lakh. So the 2 lakh also will become your bad debt. Are you with me? You need to analyze that entire circumstance, then only you are supposed to answer these kinds of things, because he was supposed to make you a payment of 10. 7 become bad in year 2. And 3 you are expecting, so year 3 you are expecting 3 lakh. But he paid only 1 lakh. So again 2 also will become bad. For that 1 lakh payment there is no treatment because the entire 10 lakh was once your income. Out of that, you only recovered 1. So your total bad debt is 9. Out of that, 7 you have already claimed as bad debt in year 2. So the remaining 2 you can claim as bad debt in year 3. Are you with me? Now, I've already told you that if you put a provision entry or if you put a provision in your books of accounts for bad and doubtful debts, you can never claim that provision as a deduction. It's impossible for a person to claim provision for bad debts as a deduction. Yes or no? But what department say, for certain persons can claim provision for bad and doubtful debts as deduction. Certain persons can claim provision for bad and doubtful debts as a deduction, especially the banks. Because according to the RBI, they need to classify their debts into performing as well as non-performing. We call it as NPAs, non-performing assets. So, in line with that, Income Tax Department also gives a concession to the banks. What they are saying is, that is the next one. Item number 12. Let's understand what exactly is this item number 12, that is provision for bad and doubtful debts in the case of specified bank. Specified banks are allowed or permitted to put provision for bad and doubtful debts and they can claim that provision as a deduction as well. So, if you are a specified bank, then you are actually permitted to put a provision and you can claim that provision as a deduction as well, and that's what we are about to discuss right now. So, listen, what they are saying is the person and to the extent provision is allowed. So, what you should understand is these persons every year will put maximum amount as provision and they can claim that entire amount as a deduction as well. Are you with me? Even though the intent is not like that, every year these banks will put the maximum amount as provision and it is allowed. There is no problem. It's allowed. According to the RBI as well as according to the income tax law, it is allowed. You can put the maximum amount every year and you can claim it as a deduction. So, let's understand which all are the banks that they can put a provision. Number 1, scheduled bank. How much is the amount that they can put as provision? Amount not exceeding 8.5% of the total income. If you are a scheduled bank, you can put a provision up to 8.5% of your total income. And you can claim it as a deduction. Listen, 8.5% of total income. What is total income? Computed before making any deduction under this clause and chapter 6A. Normally, what is total income? Gross total income minus chapter 6A. But department say you consider the gross total income that too before this deduction. On that you apply 8.5% and that 8.5% in full you can claim it as a deduction. Are you with me? Not 8%, it is 8.5%. So what they are saying is very simple, friends. If you are a scheduled bank or a non-scheduled bank or a cooperative bank other than a primary agricultural credit society or a primary cooperative agricultural and rural development bank, you don't have to study this in this manner. Only register scheduled bank, non-scheduled bank or a cooperative bank. This much is enough. Scheduled bank, non-scheduled bank, cooperative bank. They can put a provision of up to 8.5% of their gross total income, that too before claiming this deduction, because we don't know how much is this deduction. So before claiming this deduction, whatever GTI they have, you put 8.5% of that GTI as your provision and you can claim that entire amount as a deduction. Very simple. Are you with me? Great. Now what if that bank have a rural branch? What do you mean by rural branch? Rural branch means a branch situated in a place which has a population of not more than 10,000 according to the last preceding census. Say for example, we will take the example of say SBI, State Bank of India. The State Bank of India have different branches. Are you with me? each and every branch does not supposed to file any return. It is only one return required. That means the consolidated State Bank of India, the headquarters have to file the return and pay the taxes. Are you with me? Normally the headquarters can claim 8.5% of the GTI as provision, and they can claim this amount as deduction. But if that SBI say they have one rural branch, SBI will have many rural branch. Okay, for making this example simple, imagine they have only one rural branch. If they have one rural branch, or if they have many rural branch, then they can claim something more as provision. Why? Because the chances of getting default is high in rural area. Are you with me? So what they are saying is, if you have a rural branch, then you can claim something extra as a provision. And what is that extra? An amount not exceeding 10% of the aggregate average advances made by the rural branch of such bank, computed in prescribed manner by CBDT. You need to compute the aggregate average advance. You need to compute what? Aggregate average advance made by that rural branch. Then you need to apply 10%, and you can create this as an additional provision. It's an additional deduction. Apart from 8.5% of GTI, you can get this extra 10% of the aggregate average advance given by the rural branch and apply that also as a deduction. So it is actually beneficial. Anyways, you will get 8.5% of your GTI plus aggregate average advance given by the rural branch. Of that, you can claim another 10%. That also is allowed as a deduction. That's what the department says. Are you all here? So if you have a rural branch, then the amount not exceeding 10% of the aggregate average advance made by the rural branch of such bank, computed in manner prescribed by the CBDT. That's what the department says. Now friends, what if you are a foreign bank, or a public financial institution, or a state financial corporation, or a state industrial investment corporation, or an NBFC? If you are a foreign bank, or a public financial institution, or a state financial corporation, or a state industrial investment corporation, or a non-banking finance company, then the percentage of provision shall be 5% of total income. And what is total income? Computed before making any deduction under this section as well as chapter 6A. That means your GTI. The only difference is, instead of 8.5%, it is only 5%. GTI before claiming this deduction. Okay. GTI before claiming this deduction into 5% shall be your maximum deduction. That's what the department says. I hope it is clear for you. Is that okay? This is in the case of a foreign bank, PFI, a state financial corporation, or a state industrial investment corporation, or a NBFC. Now, one more thing is there. That is this note. If actual bad debt is more than the provision for bad and doubtful debt, then it is allowed as a deduction. Then excess shall be allowed as a deduction under section 36 subsection 1 clause number 7. What does that mean? What is provision? You are providing something for the future bad debts. Are you with me? In future, if bad debts comes in, again you are not supposed to claim that bad debts as another deduction. If that future bad debts exceeds the provision amount that you have given, only that excess is allowed as a deduction as bad debt. So what happens in a bank every year they provide for provision. If actual bad debt occurs, and if that actual bad debts exceeds the provision that they have put for the past year and current year, then only they are supposed to claim that actual bad debt as a deduction. Are you with me? Every year these banks can provide for provision, and they will put full provision every year. And if actual bad debts happens and the actual bad debt exceeds the provision that they put till now, then only that excess is allowed as deduction for bad debts. I hope it is clear for you. So next item is deduction in respect of special reserve maintained by a financial corporation engaged in long-term finance, that is 5 years or more. If you are a financial corporation, and you are engaged in long-term finance, then and you are depositing some amount in a special reserve, that amount that you have deposited is allowed as a deduction under section 36. Rather than calling it as a deduction, this is a kind of a tax deferral. What is tax deferral? When you deposit in the reserve, you can claim deduction. When you withdraw the amount from the reserve, that have to be your taxable income under section 41. So you can defer by depositing. But when you withdraw it in future, that withdrawal will be fully taxable irrespective of the purpose of withdrawal. So let's understand what exactly is this point. So the amount of deduction shall be least to the following. Number one, amount transferred to the reserve account during the previous year. The current year, how much ever amount that you have deposited in that particular reserve is limit number one. Limit number two, 20% of the profits derived from specified business of providing long-term finance. That is profit before claiming this deduction. Whatever profits that you have from the long-term finance business before claiming this deduction into 20% is limit number two. And what is limit number three? 200% of your share capital plus general reserve minus opening balance in the special reserve. Whichever is lower. You take these three limits. Limit number one, amount deposited in the reserve. Current year deposit in the reserve. Limit number two, 20% of your profits. Limit number three, 200% means twice of share capital plus general reserve. You take the double of share capital plus general reserve minus opening balance in special reserve. Whichever is lower. Are you with me? So you compute these three and pick the lower. Now, when you withdraw amount from that particular reserve, that entire amount withdrawn shall be taxable under Pgbp. When you withdraw amount from this particular reserve, that entire withdrawal amount shall be fully taxable. That's why at the beginning itself I said it is a tax deferral rather than a deduction. So when you deposit, you will get the deduction. When you withdraw, you will have to pay the taxes. Under section 41, subsection 4A, deemed income. All right, moving on with the next item. That is item number 13. That's the one we have discussed right now. We are about to discuss item number 14 right now. And what is that? Expenses on family planning by a company. So the one thing you have to be very careful is only company associates will get this deduction under 36 subsection 1 clause number 9. Who will get it? Only company associates will get this particular deduction. Let's understand what exactly is the impact of this deduction. Listen. Say you are a company associate and you are actually promoting family planning among your employees. You are doing what? Promoting family planning among your employees. So promoting family planning among your employees is considered as a good thing in India. Why? Because right now unofficially we are the most populated country in the world. Why unofficially? Because there was no census happened. So unofficially we are the most populated country in the world. So what income tax department say, if you are a company, then you are promoting family planning culture among your employees. That's a good thing. So the expenditure that you are incurring for promoting family planning is allowed as a deduction under 36. But there is one thing. Depends upon the type of expenditure that you incur, the type of deduction is also different. So we can divide this expenditures into two. Number one, capital nature expenditure. Capital nature expenditure. If you are incurring any family planning capital nature expenditure, say for example, you are placing a machine where the employees, if they swipe their cards, they will get pills and other medicines from that particular machine. Okay, you don't have to spend it. You don't have to go to medical store. You come, swipe your employee card, you will get the medicine. Make use of it. Okay, so this is what the company says. So the cost of the machine can be called as a capital expenditure. It is allowed as a deduction in 5 equal annual installment. It is allowed as a reduction what? In 5 equal annual installment. So, if you are incurring an expenditure which is in capital nature, then it is allowed as a reduction in 5 equal annual installment. That's what the department says. And simply by placing a machine, it will not do good. You have to fill medicines. Yes or no? That medicines and pills can be called as a revenue nature expenditure. If you are incurring a revenue nature expenditure, that is allowed as a reduction in that year itself. In that year itself, you can claim it as a deduction. There is absolutely no problem. That's what the department says. So, if you are incurring a capital nature expenditure, that capital nature expenditure is allowed as a reduction in 5 equal annual installment. If you are incurring a revenue nature expenditure, that revenue nature expenditure is allowed as a reduction in that respective year itself. So, capital 5 equal annual installment, revenue that year itself, you claim it as a deduction. So, let's go back to the theory, friends. Listen. This deduction is allowable only to companies and not to the other assessees. Where expenditure of capital nature, deduction shall be in 5 equal annual installment. If you are incurring an expenditure that is in capital nature, then you can claim that expenditure in 5 equal annual installment. If it is revenue nature, it shall be allowed as a reduction in the year of expenditure itself. Revenue nature, you claim it as a reduction in that year itself. Note, assessee would be entitled to carry forward and set off of the unabsorbed part of the allowance in the same way as unabsorbed depreciation. If you don't have adequate profits to charge this deduction, if you don't have adequate profits to charge this deduction, then that unabsorbed portion shall be treated as similar to unabsorbed depreciation. That means you can carry forward it to unlimited subsequent years. That is the thing. You can carry forward this to indefinite or unlimited subsequent years. That's what the department says. I hope it is clear. The one thing that you have to be careful is you should be a company. If an individual is promoting, a sole proprietor is promoting family planning among their employees, only they will get congratulations. No deductions. If it's a company as the only, they will get a deduction under Income Tax Act 1961. I hope it is clear for you. Moving on. This is item number 40 now. It is item number 15. Deduction of STT paid, security transaction tax paid. So, the point is security transaction tax, deduction of STT. So, listen friends, very simple point. Say, when you are purchasing and selling security, you have to pay what? STT in India. Now, the question is, can you claim that STT paid as a deduction? What can you claim that STT paid as a deduction? Answer is very simple. The amount of security transaction tax paid in the course of business shall be allowed as a deduction subjected to one condition. What is that? Such income from taxable security transaction is included under Pgbp. That simply means your income under Pgbp should be from buying and selling of securities. Then only you can claim STT paid as a deduction. That means if you are a full-time trader and you are buying and selling security and you are making profit out of it, and that profit is your Pgbp profit, then from that profit you can claim STT paid as a deduction. That's it. Otherwise, don't even think about claiming STT as a deduction. Are you with me? Very simple. So, I'm a chartered accountant, I'm investing in shares and I'm paying some STT. Can I claim that STT as a deduction from my taxable profit? Not possible. Then, item number 16. Deduction for commodity transaction tax paid in respect of taxable commodity transaction. So, just like security, you are buying and selling. In market, you can buy and sell commodities. In market, you can buy and sell what, friends? Commodities. When you are buying and selling commodities, you have to pay what? Commodity transaction tax. Like when you are buying crude, silver, gold, etc. These are called as commodities. When you are buying commodities and selling commodity, you have to pay what? Commodity transaction tax. So the question is, can you claim that commodity transaction tax, CTT, as a deduction? The answer is very simple. If purchase and sale of commodity is your business income, then you can claim the commodity transaction tax paid as a deduction. Otherwise, not. Are you all here? If purchase and sale of commodities are your main business income, then you can claim the commodity transaction tax paid as a deduction. Otherwise, no. I hope it is clear for you. commodity transaction tax, whether it is allowed as deduction or not. That was our debate. Moving on to the next one, friends, item number 17. Again, unnecessary, but let's discuss that also. Amount of expenditure incurred by a cooperative society for the purchase of sugarcane at a fixed price by the government allowable as deduction. That means expenditure incurred by a cooperative society engaged in the business of manufacture of sugar for the purchase of sugarcane at a price equal to or less than price fixed or approved by the government. That means when you are buying a sugarcane, you are a cooperative society and you are buying sugarcane for the purpose of manufacturing sugar. You are supposed to buy that sugarcane only for a price which is fixed by the government or for a lesser price. You are not supposed to buy that sugarcane for a higher price. If you buy it for a higher price, we will not give you deduction for that higher price. They want to regulate the price of sugar. If the sugarcane becomes more costly, sugar also will become more costly. If the sugar becomes more costly, home budget will be more costly. Are you with me? So government say, your society manufacturing sugar, you will get deduction for the purchase of sugarcane only if that cost of sugarcane should be similar, same as that of cost fixed by the government, or it should be at a lesser cost. And item number 18, last one. What is that? Mark II market loss, section 36, subsection 1, clause number 18. Let's understand. What do you mean by Mark II market loss? Means method of valuing assets at their current value is allowed as deduction if it is allowed under ICDS. Say for example, I'll take ICDS 2. ICDS 2, valuation of inventories. Valuation of what? Inventories. According to ICDS 2, department say every year inventory have to be valued at either cost or net realizable value, whichever is lower. Either at cost or at NRV, whichever lower. Every year you have to value your inventory either at cost or net realizable value, whichever is lower. This year, say the cost was 1 lakh and the NRV was 1.50 lakh. So I will be valuing this at cost. Yes or no? Next year, NRV become 80,000. NRV become what? 80,000. Then I will value it at a lower price. Are you with me? If there is a fall in the value of the closing stock, there will be a fall in the profit. Are you with me? So this is not on account of any activity. This is on account of revaluation. These revaluations, if you are incurring any loss, whether you can claim it as a deduction, the answer is yes, only if it is as per ICDS. You are doing some mark to market loss, some revaluations of the assets, and you are incurring a loss. Normal revaluation loss, ignore. If it is as per the ICDS, then you can claim it as a deduction under 36. If it is any other mark to market loss, it is fully disallowed under section 40A13. All other mark to market losses are fully disallowed. Only those mark to market losses which are permissible as per ICDS, you can claim as a deduction. Are you all here? So these are the 18 items that we have to discuss under section 36. I hope all the 18 items are clear for you. So friends, these are the deductions under section 36. By this point, I can say all the deductions under section 36 is completely over.
So my dear ones, this is CA Jose Kurian, and this video is to inform you about how to purchase our book as well as recorded lectures. For the book, you visit www.cajosekurian.com. Then you scroll down and you can see our both handbook as well as workbook for CA as well as CMA, Inter as well as Final. For the lectures, you scroll up, then click onto the classroom. In the classroom, you can scroll down and you can see all courses listed. We have CMA Final English as well as Malayalam, then CA Final English as well as Malayalam, then we have CA Inter English as well as Malayalam. Then select your course, make the payment, and you will get instant access. Alright, now what are you waiting for, friends? Subscribe now. All the very best, take care, and God bless you all.